we're in an economy that still has a lot of inflationary pressure.
I would not assume that inflation numbers would be super sticky, but they would certainly be bumpy.
We are still looking for disinflation to continue.
We're talking about inflation behaving, okay? We're not talking about inflation accelerating.
Inflation will be sticky. Inflation will be absolutely sticky. And I do think that that actually warrants, over the long term, the Fed rethinking its inflation target.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City. Your week begins right now. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Lisa Abramowicz, together with Annmarie Hordern. I'm Jonathan Ferro. Your equity market has not really done much over the last couple of days. At around 8:30 Eastern, expected to do something. I think we have to begin this morning with the words of Chairman Powell. It's too soon to say whether the recent readings are more than just a bump. 8:30 Eastern time. Are we going to get another bump in the road?
And how much actually consists of a bump? That's actually one of the key questions. If it's in line, we've already heard this from numerous types of analysts saying an inline print is going to be basically a beat, and you probably will get a rally in markets. How big of an upside surprise do you need for this Federal Reserve to really reconsider the decision, not only to cut rates in June, but just more broadly to cut rates 3 times this year?
Let's go through the estimates. 0.3% month over month for core inflation is the estimate. The previous number, as you all know, was 0.4. When you go through the numbers, the predictions on Wall Street, very few people are looking for an upside surprise this morning.
That's right. You see some actually coming in with a little bit lower. But I go to Stephen Stanley at Santander overnight, putting out this note, talking about the number of analysts, what he's seeing is trying to spin tomorrow's results. This idea, and Lisa, you said this yesterday, are expectations basically a beat. But when he looks at that at a 0.3% rise month over month, that ends up being annually 3.6%. And he said it is highly unlikely for anyone at the Fed for that number to satisfy them.
When you talk about expectations, let's talk about market positioning. The bearish bets on treasuries absolutely skyrocketing ahead of this report, which basically sets the market up for a massive short squeeze if we get anything other than a huge upside beat. This is important. You talk about market expectations. How big does that upside surprise have to be to fulfill all of these bearish bets of people expecting some runaway inflation? And if we don't get that, could you get a monster rally in bonds and a monster rally in stocks?
Pair those bearish bets on treasuries with those bullish bets on energy right now. Just listen to this. Laurie Calvasina, RBC, sticking with energy. Morgan Stanley's Mike Wilson, overweight energy. Marko Kolanovic over at JP Morgan, guess what? Stay overweight commodities. That has quickly become a consensus call.
And it's become the hedge against inflation because it is more certain, and it's not just oil. We've been talking about this. It's also gold, which is, again, one of the biggest mysteries as it hits all-time high after all-time high. It's also iron ore. It's all of the precious metals as well as industrial ones.
We hear analyst after analyst talk about they are overweight, but Stuart Kaiser yesterday was talking about the fact around this table that oil needs to prove itself that it could sustain these levels. How much of this is temporary, and does the Fed just look through it? It's not part of core.
Crude this morning positive by a third of 1%, 89.74 on Brent, WTI 85.54. The broader price action shaping up as follows on the S&P 500. Some mild days of price action. Monday down a little bit, Tuesday up a little bit. Today totally unchanged on the S&P. Jim Reed over at Deutsche Bank. Lisa, I know you read Jim's work as well. We've gone 7 consecutive sessions without a new record. The longest period without an all-time high since January.
Which is notable, and the only negative thing you can say about a rally that hasn't really gone down very much at all this year. That said, there's been some really interesting price action under the hood. What you've seen is the Magnificent Seven underperforming. NVIDIA, what it did yesterday was fascinating to me. The fact that Intel came out with a chip that may or may not take off. Intel shares, meh. NVIDIA down. There is a feeling that people are trying to hedge some of the high flyers for most of this year.
Lisa mentioned the bond market as well, so let's check in on the scores this morning. Yields just about unchanged, lower yesterday on a 10-year at the moment, 4.36, on a 2-year, about 4.74. Coming up this hour, Dan Morris of BNP Paribas as investors await the latest CPI print, Tobin Marcus of Wolfe Research as President Biden meets the Japanese PM, and Bloomberg's George Ferguson with new concerns over at Boeing. We begin with our top story. Investors awaiting today's inflation data. Dan Morris of BNP Paribas with this to say. March CPI data will be critical, telling us whether the big increase in monthly services inflation was just a blip and whether goods inflation is returning. Dan, I'm pleased to say, is with us now for more. So, Dan, are these bumps in the road or new terrain?
Well, I think, as pointed out, I think from one of your previous commentators, we're nonetheless still talking about a lower level of inflation by the end of the year. So we don't want to get too carried away. Even if it is a bump, no one's talking yet about a re-acceleration in growth or a re-acceleration in inflation or a Fed hike as opposed to cuts. So it is a question about how smooth the path is, but it is going in the right direction. So on one hand, even if we do get that 0.3%, which, as pointed out, would be 3.6, which is not 2%, that's too much, but we do still anticipate it is going to go down, and that's what we want to focus on.
Dan, yields have repriced. Lisa talked about positioning in the bond market. Yields have repriced higher by around 50 basis points year to date at the front end on a 2-year, at the longer end on a 10-year as well. Has the boat become too loaded to the one side in the bond market?
Well, actually, we're looking at steepener, so in anticipation, at least for nominal real yields, probably in the belly of the curve to start going down. So, yeah, there is a view that if you think about positioning, kind of where the market's gotten at this point, perhaps it has gone as it does to the other extreme, and at this point we think there is potential to move back in the other direction.
Given that, Dan, this is a reason why some people are saying that if we get an inline print today, or if you get a lower than expected inflation rate, it is going to be a rip-roaring rally in bonds as people go back to this idea inflation's coming down. Would you be an active buyer of duration if we do get a downside surprise?
It certainly would help if you came in at 0.2%. I just don't know how likely that is. I mean, we really, even if we do look at the headline figure, it is going to matter a lot what the components are. I mean, we've talked about owner's equivalent rent, which we know doesn't matter anywhere near so much for the PCE, for the personal consumption expenditures index that the Fed looks at. It is going to be really the stickiness of services inflation. The good news is with the payrolls data we got last week, average hourly earnings continue to fall, so that's good. But the big question mark will be goods inflation, which has potentially started to turn up given the conflicts, the issues we know we have in shipping in the Middle East.
If we do get some sort of rally in bonds, is that going to be positive for stocks? Is that going to be something that does fuel a new leg of the rally? Or is that kind of a question mark around why bonds are rallying and this potential for more weakness later on?
It depends a lot on what's behind either the increase or the decrease, because we know how sensitive growth stocks are to moves in real rates. So if it is a lower print and we put back in some cuts from the Fed, that I normally would be supportive for growth stocks. If it is higher inflation, that's not necessarily so bad. It's always a bit of a balance. Okay, rates maybe don't go down so much, but we're at the levels we're at. We've already priced that in. And a bit more inflation, well, that should mean higher revenue. So I think there is a scenario where as long as it's not a weak growth data that we get subsequent to this, equities for the most part should be supported, we believe.
Daniel, you just mentioned transportation problems in the Middle East. Is that really an impact on goods in the United States? Isn't this more of a European problem?
Well, certainly we haven't seen the data yet. And even if you look at the European inflation data that we have already gotten for March, which is actually a positive signal, we shouldn't forget that when we had that initial surprise in CPI inflation in the U.S., we thought it was just a U.S. problem. But then we saw, particularly on the services side, it showed up in Europe as well in January and February. Well, the March data out of Europe was much lower. So if anything, that maybe is a hint, that we are going to see a decrease, and whether or not the goods inflation really spreads to the U.S., admittedly, it's not a huge factor, but low goods inflation has been a big part of the decline in CPI we've had over the last year.
Even though, of course, commodity prices, the prices of crude trickling down to oil prices do not impact core, how are you dealing with this surge in commodities when you're thinking about an uptick in inflation?
Well, looking at it a bit separately, we do like commodities and we are overweight, and we do appreciate, some of that is just, as you mentioned, a hedge against inflation. We know it's also a reflection of the geopolitical risks that we're facing, and not really so much because of the increase in demand. And that's what you want over the medium term, or a reduction in supply over the medium term, to think that prices are going to be sustainably higher. But for now, we do see it as an opportunity.
Dan, let's talk about Nvidia. Lisa mentioned it. The stock was down at the lows yesterday by close to 5%. It's been a really difficult start to the week. And then we had numbers from TSMC, Taiwan Semi, quarterly revenue absolutely exploding higher. We're talking about the main chip maker to Nvidia, to Apple, a better than expected 16% rise in March quarter sales. Is there anything to worry about in that space of the stock market?
Well, if we think more broadly about the outlook for earnings for tech, say if you take NASDAQ 100 and look at how much earnings expectations, forward earnings expectations have gone up over the last year, a big chunk of that is Magnificent Seven. A lot of it is semiconductors. You don't see the breadth there really that you do want to see. So to some degree, irrespective of what happens, say, around semiconductors, you want to see some earnings momentum in the other parts of the market, other parts of the growth market, other parts of the value market. And honestly, I think that is a bit lacking at this point.
So what are you doing around that, Dan? Are you basically reducing some of your exposure to some of those tech high flyers and moving into other areas like commodities, like cyclicals?
Well, we do like tech. We're neutral on the U.S., but it's always a matter of where you see the best relative opportunity. So we're more interested in what's happening in China, in fact. So we all know about the valuation story. Are we at the point now that we're at the bottom in terms of the earnings downgrades that we've seen, it seems like years now? If that's starting to turn around and you have those low valuations, that's an example of we see a better place to take a position where you have more upside than trying to necessarily predict what's going to happen to NVIDIA next.
Dan, are you saying you're more constructive Chinese tech than you are US tech? Is that what you just said?
No, we're overweight Chinese equities and in particularly and importantly, more of the large cap domestic space, A shares, but large cap as opposed to, say, MSCI China.
Interesting. Dan Morris of BNP Paribas. Dan, thank you. Great to catch up. Really strong numbers from Taiwan Semi overnight. I want to talk about the bond market as well. Tom Titsouris of Strategas is going to join us a little bit later. Here's a flavour of what Tom's got to say on fixed income, the Federal Reserve and policy down in DC. You do not want to miss this conversation. Washington is committed to run the economy at full employment at all costs until the election, and the Fed is looking for every excuse possible to cut to aid this cause. Strategas in the next hour of Bloomberg Surveillance.
Which is what people say usually quietly and not when they're on air, but the suspicion that maybe this Federal Reserve is biased toward keeping the economy hotter than cooler running into the election. I'm not going to go into that particular thing. He will, and I'm looking forward to it, but it does raise a question about why.
I'm surprised he did.
Well, right, because the question is, what gives people conviction? Is this what's giving them a sense that this Fed's going to cut, even if the data, as we heard from Bob Prince over at Bridgewater, just is not cooperating?
You're exactly right. He said the quiet part that people tell us behind the scenes out loud. But that is why this inflation print is so important. But not just for the Fed, but because of this White House. Because if you're trying to run an economy that is hot, at the same time, try to quell inflation, because this is what continues to come up in polls. Inflation data, 8:30 Eastern Time. The estimate 0.3% month over month on core, stripping out food, stripping out energy compared to the previous read of 0.4. Let's give an update on stories elsewhere. Here is your Bloomberg brief this morning with Danny Berger. Hey, Danny.
Hey, John. At least 3 people are dead after an explosion at a northern Italy hydropower plant owned by Enel. The company says that a fire had impacted a transformer without providing further details. They're Italy's largest power supplier, and they shut the plant down immediately for safety reasons, but local power supply was not affected. Fitch has cut its outlook for China's long-term foreign debt from negative to stable. The ratings agency says that rising economic uncertainties have eroded fiscal buffers. Although Fitch sees government debt increasing in coming years, it affirmed China's A+ rating. More trouble for Boeing. The FAA is investigating whistleblower complaints that the company took shortcuts to ease production bottlenecks on the 787 Dreamliner. The plane maker says the claims are inaccurate and do not represent the work it has done to ensure the safety of the plane. Shares of Boeing are down more than 30% so far this year. Scrutiny of the manufacturing practices have been building since one of the planes experienced a mid-air accident in early January. That's your Bloomberg brief, John.
Danny, thank you. Again, this comes with a warning. If you're flying this morning and you're flying with Boeing, turn the volume down. Here are the allegations. Factory workers wrongly measured and filled gaps that can occur when airframe segments of the 787 are joined together. The assembly process could create significant fatigue in the composite material and impair the structural integrity of more than 1,000 of the wide-body jets in service. These allegations are quite something.
And then he also said that he had serious acts of retaliation against him, and then the previous whistleblower died of a self-inflicted, supposedly gunshot wound last year. So a lot mounting that needs to be investigated.
Pretty shocking stuff. More on Boeing a little bit later this morning. Up next on the program, US Steel in focus.
The relationship is bigger, more significant than a single commercial transaction, and that's going to continue, whether there's a disagreement on a single transaction.
That conversation up next, live from New York City this morning. Good morning.
Earnings season is coming.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
It all starts Friday on Bloomberg. Context changes everything.
It is CPI Wednesday, the data just around the corner, 8:30 Eastern Time. Equity futures on the S&P totally unchanged again. Such muted price action at the close. Monday, again on Tuesday. In between, though, at least intraday Tuesday, some big swings in there. I can't explain them, but they existed. In the bond market on a 10-year, 435.77. Under surveillance this morning, US Steel in focus.
For 4 years in a row, the United States and Japan are the number one foreign investors in each other's respective countries. In 2021, when there was an election in Japan, some foreign entities were looking at buying Toshiba, and Japan said for national security interests, that's not going to be permitted. So there's a context here. One is that the relationship is bigger, more significant than a single commercial transaction, and that's going to continue, whether there's a disagreement on a single transaction.
Here's the latest this morning. The Japanese Prime Minister Kishida arriving in Washington for the country's first state visit to the US in 9 years. Hanging over the visit, Nippon Steel's planned takeover of US Steel. Tobin Marcus of Wolf Research writing this. Japanese officials suggest they believe their best play is to stay quiet and work with the Committee on Foreign Investment to try to secure a positive recommendation. Avoid putting Biden on the defensive and see if the situation improves after the election. Tobin joins us now for more. Now, Tobin, as we know, a big element of this is to try and secure the vote in places like Pennsylvania. Is that working?
At the moment, I would say it's not working yet. Biden's still behind in the polls across the blue wall states that he needs to win. Polling very tight in Pennsylvania and Wisconsin, a little bit more pro-Trump in Michigan, but I think all well within kind of competition distance for both candidates. So, it has not worked yet, but it is understandable, I think, that the Biden and the Biden campaign are looking at that swath of political territory with a very keen eye.
Tobin, do you sense the Japanese understand, or are we at risk of isolating some of our allies?
I think they get it. I mean, I think that we've seen in the response to this situation from Prime Minister Kishida and sort of officials around him in the wake of Biden coming out sort of surprisingly strongly against the deal a few weeks ago, that they understand there's no real percentage in pressing him on it at this point. The company is still very gung-ho on the deal. I mean, you're still seeing lots and lots of, advertising, lobbying focused on DC types kind of touting the economic benefits of the deal. They're continuing to try and engage with the union, even though the USW seems very dead set against the deal. So it's not as if the Japanese side in general has given up, but I think you are seeing at the governmental level, they're not making it their number one priority. The summit this week is much more focused on security issues and defense cooperation, where I think the mutual interests are more aligned. And, they will try to get a good outcome here, but know that it's not a foregone conclusion.
When it comes to the CFIUS review, what the administration is looking at is whether or not there is this connection to China. Do you think that's warranted?
I think this is all downstream of politics. I think if you were doing a purely neutral, staff-driven CFIUS review with no concerns about politics whatsoever, if this were a company that did not have United States in the name, that had a kind of iconic legacy to it, I don't think authentically that there would be problems. I mean, as we're seeing in the summit more broadly, Japan is probably our most important ally in the Indo-Pacific, one of our most important allies globally. I think Japanese control of U.S. companies in general is not a big security concern. Steel, a little bit of a special case, but I do mostly think that we are seeing an exercise in mitigating the kind of potential political liability of allowing this, again, quote unquote, iconic U.S. company to be acquired by foreign entity, regardless of where that's domiciled.
And when you talk to Japanese officials, they say actually uniting these two companies would be a force against China. So we're at risk in Washington to create this boy that cried wolf situation when it comes to national security concerns.
Yeah, I mean, you heard Ram talking about this a moment ago in the clip that you played. Like, it's not unique to the U.S. It's not unique to this situation for there to be political considerations or even economic considerations around protecting kind of domestic champions in various different industries. So, again, it's not, I think, the ideal situation. It's not what you'd want as you're trying to deepen both economic and security cooperation with Japan. But I do think that they get it. It's not derailing the other efforts to knit a tighter relationship. Again, the sort of suite of deliverables that are being rolled out around this summit, I think both sides feel quite good about in terms of Japan's, sort of continued shift towards being a full spectrum geopolitical actor in the Indo-Pacific, sort of undergoing their own military modernization and preparing to cooperate a lot more with the U.S. in deterring China.
Tobin, it's getting a lot harder to distinguish politics from policy at this point. And I do want to get your thoughts ahead of an interview that we have later on with an analyst for Strategas, where he came out, and John mentioned this, quote, "It's fascinating to me. Washington is committed to run the economy at full employment at all costs until the election, and the Fed is looking for every excuse possible to cut to aid this cause." Would you agree with that assessment? Is that kind of the feeling that you hear from the clients that you speak to?
So I will say it's a very active debate among my clients and other folks in the DC space, the extent to which Fed decision making this year is politicized. I don't really agree with the notion that the Fed is putting its finger on the scale for the sake of an electoral outcome. I've sort of heard that talking point a lot. I don't really think it's right. I mean, I think Powell's very clear political incentive is to ride off into the sunset as the person who defeated this outburst of inflation. I think he cares a lot more about his legacy, about not being the next Burns, than he does about getting reappointed or the sort of inevitable political attacks that he'll face from both sides, depending on when they cut. If they cut in June or July, they'll be criticized for cutting too early and too much. If they cut in September, they'll be criticized for cutting too close to the election. If they wait until November or December, they'll be criticized for holding rates high, sort of longer than necessary in a way that hurts Trump. So he's damned if he does and damned if he doesn't, I think, in terms of the political incoming he's going to face. I think that their incentive is to try and actually navigate the genuinely challenging set of empirical questions that they're facing around the appropriate path for rates. Not that they'll do it correctly necessarily, but I do think that we are seeing their sort of authentic best effort to try and manage both sides of the dual mandate.
There is this question, though, of course, of whether the Fed comes under attack in terms of its legitimacy in another administration and whether it has sort of an incentive to preserve more of a status quo. Do you believe that? I mean, this is sort of one of the theses, one of the sort of conspiracy theories underpinning this, which is the reason why we hear this so much.
Right. I mean, if you gave Powell truth serum, would he prefer Biden to Trump? Probably. But I don't. He is a registered Republican. It's not as if he's sort of somebody whose track record would suggest that he's going to sort of move heaven and earth to get Biden reelected. Generally, when we look backwards at the record of what Fed policy has actually been in election years in the period since Nixon and Burns, we don't see any good evidence that there's any sort of historical pattern around election interference. You're no more likely to get cuts than hikes in election years. You see, the deviation between the Taylor rule and actual Fed fund rates in election years is, if anything, more hawkish than it is in non-election years. So, I think there's not a lot of empirical track record to point to on this. And I don't really think it makes sense for Powell. Again, he's towards the end of his career. I'm sure he would like to get reappointed, but I do think he cares much more about not sort of mismanaging the situation and going down in history as the person who allowed like a big re-acceleration of inflation, totally failed at the sort of, historically important job that he's facing at this kind of inflection point. So, and again, in terms of the legitimacy of the Fed, they will face quite sharp political attacks no matter what they do. And so I don't think that trying to solve for that really makes a ton of sense.
Well
so
said.
I don't buy this. I hear it a lot. Like the theory is definitely out there, but I'm not on board.
Lose-lose. Tobin Marcus of Wolf Research. Super diplomatic. An active debate. It's an active debate. And to his point, it doesn't matter when they go. They'll be criticised by someone about something, whether it's June, whether it's right before the election or right after it.
And what he said also is that this Fed chair does not want to go down in history as Arthur Burns. He doesn't want to go down in history as fueling an inflation surge that was akin to the 1970s.
I don't know about retiring, though. Don't you want to go and deliver some $1 million speeches? Don't you want to get on that circuit?
You're just imagining yourself in public policy.
Bramo, if I could deliver a $1 million speech, I'm not even hiding that if I could. If someone wanted to pay for that, I'm not sure what I'd talk about.
PSA, please, reach out to John.
Then he's going to disappear into the sunset, all right?
Italian football.
We're going absolutely nowhere. Going into inflation data, equity futures on the S&P unchanged, dead flat. Likewise on the Nasdaq. On the small caps, the Russell. You spot a theme here, going absolutely nowhere. Let's switch up the board and get to the bond market. 2-year, 10-year, 30-year, going somewhere this year, and that's higher, up by something like 40 to 50 basis points across the curve on a 2-year, on a 10-year, year-to-date. At the moment, just about unchanged after a rally yesterday on Treasuries, 435.77 on a 10-year, on a 2-year, 473.86. I just wonder how much of that was about what was developing in the commodity market, Lisa, where crude was just starting to break lower, break back below 90 on Brent.
That's what we saw yesterday, which is part of the reason why you did see a bit of a reprieve in the bond market, also at a time where people are saying maybe we've gotten ahead of our skis in terms of bearish bets on bonds. There was a hint of that coming out yesterday, even with, I will just note, a 3-year auction yesterday that did not go that well.
I know.
Just want to point that out. And there's another 10-year note auction today at 1 p.m. after the CPI print. I'm curious to see whether it inflects one way or another. It seems like that's what people are waiting for.
$39 billion in 10-year notes. If you're interested, coming a little bit later this afternoon. If you want to buy some 30 years tomorrow, there is $22 billion worth of supply coming to market. That's the Treasury market. And perhaps we compare what's happening there with what's happening in precious metals. The rally in metals has been absolutely relentless. I think in March, gold was up something like 9%. We've had another move, a decent move in April as well, just off all-time highs.
And this really goes down to what Mohamed El-Erian was talking about. We've heard this a number of times. Central banks are buying. China is buying. There is, on the margins, diversification away from the dollar, not necessarily de-dollarization or the end of America as we know it, et cetera, et cetera. Some people might go there. Good luck. There is this question, though, about how much more fuel there is to this and whether it is some sort of indictment on the idea of treasuries as a haven asset.
We were straight with Mohamed yesterday. Was this about sanctions or about Treasury supply? He said this is about sanctions.
He didn't like the term, though, to Lisa's point, de-dollarization. He said, I wouldn't go that far, but it is about the policy and the sanction policy. And you hear this a lot from people. They want to make sure when they're looking at central banks, they think that this is the reason why they are diversifying, putting some more money into gold. Because if this is where the U.S. policy is today, what happens when there's more geopolitical risk in the world, and you know that they can go back to that sanctions policy?
Lots of physical buying. Gold just a little bit softer on the session, down by 0.2%. Under surveillance this morning, our top stories, Boeing's worries continue. A whistleblower coming forward with accusations the company cut corners on the assembly of the 787 Dreamliner, which may, quote, dramatically reduce the life of the plane. The outgoing CEO, Dave Calhoun, being called to testify on Capitol Hill April 17th. Now, sometimes we talk about a grilling and they're not going to get a grilling. I think this guy's going to get a grilling on Capitol Hill.
Absolutely. What we're already hearing from Senator Blumenthal is that Boeing has repeated shocking allegations about their manufacturing failings to a point of an appalling absence. What struck me about this whistleblower is that he's worked at Boeing for 10 years. So he obviously was very committed to this company. So to come out and outline everything that's going wrong, he's clearly very concerned. And it just feels like this grilling is going to be more bad news for Boeing.
Should we get the numbers from Delta? I know you've been super excited about them.
Well, yeah, we did get the numbers from Delta. And I will just say this is connected to Boeing because it really raises this question of whether they can deliver planes that are very much in demand because the demand is very much there. Delta beating expectations, expecting second quarter profit and revenue to still exceed revenue expectations even more. Just giving you this from Ed Bastian, the CEO. Delta expects no let up in demand. The carrier hasn't seen a dip that historically has occurred before the start of the summer season. Both Memorial Day and early peaks at the 4th of July look quite strong. This goes to the question of consumer spending. This goes to the question of just whether the consumer is still strong. This is classic discretionary spending, and they are spending it. This is the reason why I've been so interested about Delta, because even with all of the hangups, even with fuel prices going higher, they're able to pass it along, and there still is that steady demand, John.
The stock is positive in the pre-market by something like 2.9%. More on that story a little bit later. I want to turn to Apple, continuing its shift away from China. Bloomberg reporting the company is doubling its iPhone production output in India. During the last fiscal year, 1 in 7 iPhones were being made in India, totaling $14 billion US. However, China remains Apple's largest overseas market and iPhone making hub. That might be the case, but you can see quite clearly that D word. They are diversifying big time. You see it in the numbers.
When you saw, I think, something like 14% now of their iPhones being produced in India, it goes to this question, are they saying one thing and doing something else? Saying that they're committed to China, they want to remain there, playing the ultimate diplomat. Tim Cook has been that person. While on the other side, just kind of, come on. produce this a little bit more?
The timing of this is interesting because he's just off a trip that he was in China, saying that they're committed to the company. But that 14%, that's 1 in 7. This is the whole idea of friendshoring. And if that's where we are today, where is it going to be 10 years down the line? Because a lot of geopolitics that cloud this story.
That's the latest on Apple. Let's turn to the main event. US inflation data about 2 hours away. The median estimate in Bloomberg survey calling for the core figure to rise 3.7% year over year, making the smallest gains since April 2021. Francis, I'm pleased to say, is with us now to explain that one for us. So, Francis, let's get to that. We stabilise at 3, yet they're still able to cut interest rates. Can you help us understand that a little bit more?
Well, it comes back to what the Fed has said to us, which is they are trying to land this economy, a soft landing, and 3% by standard Taylor rules. And most of the way the Fed looks at inflation is enough to want to keep those real rates from climbing. What I'm more interested in, though, John, is not how many cuts we're going to get in 2024, but what the totality of this easing cycle is going to look like. For most investors, whether the Fed starts in June or September, frankly, even if they cut this year, is not going to be as relevant as whether we are indeed in a soft landing. It's going to be 3 to 5 cuts total, or whether we're heading towards a recession and it's a more standard easing cycle. I'm in the latter camp. And again, for most investors, that story is far more important than some of the decimal places we'll see today on CPI.
Francis, you've said it repeatedly on this show. You don't get to have your cake and eat it too. You're not getting a soft landing and meaningful cuts. If you're in the other camp, what is a standard easing cycle? Just remind us, because it's been a while.
Sure. Well, we see the Fed heading back towards what they'll consider neutral. Now, we have raised that estimate from 2% to 3%, but this is a central bank that will cut hundreds of basis points if we enter a recession. That is not what is currently priced in this story. And that's why everyone's talking about the inflation number being so relevant. But my eyes are on the labor market and what's starting to crack there. Rehiring activity coming down, wage growth decelerating, and some of the problems we're seeing with consumers. Credit card delinquencies started to rise, and interest rate sensitive pockets of retail sales like housing, electronics, furniture, those are declining over the past year and a half. That's evidence that this economy is really starting to deteriorate. And economies, they don't break in straight lines. They don't break slowly. If that labor market starts to go, it will be in a nonlinear fashion. And that story, to me, is the one that I'm currently watching.
Francis, why, if there is some sort of break, does that mean that inflation is going to come back down far enough for the Fed to be justified to cut by hundreds of basis points? This has been one of the key questions, especially given commodity prices, especially given reshoring, especially given the potential for things like tariffs.
It doesn't, Lisa. And that's the big challenge is this is a central bank that is probably going to have to make, as we call them, critical concessions and recognize that they are now at the point, I believe in the next 6 months, where the weight of that dual mandate will start to become heavier. And while we've always said that this was a great thing for the Fed to have a dual mandate, full employment and price stability, a lot of other central banks will not be in that position. Now, I will say that wage growth is coming down and the demand side will probably bring inflation back down. We're not heading back to sub 2% inflation. And so the Fed's going to have to choose. If they have millions of people who are suddenly out of work, do they prioritize that over the 2% target? And whatever that means. Now, some of that is subjective call. And unfortunately, economics and these macro forecasting is in part art, is in part science. But the art component and the interpretation of how the Fed will respond when their dual mandate comes into question, that's going to create, and already is, a huge dispersion in Federal Reserve rate forecasts.
The economic artwork looks like a Rorschach test because, frankly, you can read whatever you want in this data. And it's come out consistently showing both strengths in certain places and weakness in the places that you mentioned. We heard yesterday from Mohamed El-Erian. Listen to what the companies are saying. This just recently out of Delta, just moments ago, that it expects no let up in demand. Usually there is a lull in summer travel or ahead of the summer season. They see nothing of the sort. They see very strong travel bookings and people are willing to pay higher prices. How do you pair that type of message with, on the margins, this idea of delinquencies picking up and small businesses expressing concern?
The U.S. economy is incredibly desynchronized, much more than we have seen certainly in my career, and in some cases, the most we have on some of this data record. So CEO confidence at big companies is looking very strong. I mean, that's in a reacceleration phase. But look just yesterday at small business optimism, or pessimism in this case, which is showing really clear recessionary signals. The goods economy is deflating, not just disinflation, but deflating. Low-income households and consumers are incredibly pessimistic. Why? Because they are borrowers. These are the people who rely on those interest rates to help them. They are very negative. High-income households who are benefiting from the stock market and house prices and our savers, they're doing really well. So it's not so much that one view is right or one view is wrong, it's that this economy is not operating holistically. And even we've seen some data that shows that individual states are really struggling with their rise in unemployment rates while others are not. So the best approach is not to cherry pick from one side or the other, but look at the holistic view. Now, my personal view is that once the labor market starts to deteriorate, it won't matter where you are, whether you're the CEO of a major company or you're running a bodega, you're still going to view this as recessionary. But right now we're in an air pocket where there really is a major desynchronization. That's not playing with the data or interpreting it differently. It's because this economy is different.
When you look at this desynchronization, how big is that gap between high-income consumers and lower-income consumers?
Well, it's sizable, but just a reminder, the top quintile, the top 20% of Americans spend 35% of total expenditure. And this is one of the reasons why, if they're benefiting, the aggregate economy is doing really well. So when we look at things like GDP, our sense is, we've even had these discussions on my team, is it possible we don't experience a GDP recession because high-income consumers hold up that GDP number, but there are pockets that feel really recessionary? Policymakers are going to have to be very sensitive to that, because not everyone's reality is going to be the same. Forget Wall Street versus Main Street. This is going to be like downtown versus rural, California versus New York. We're going to see a really wide divergence in economic outcomes across this country by incomes, geographies, and sectors.
Small versus large, small business confidence. Just terrible in the last 24 hours. Francis, thank you. Francis Donald there at Manulife. Compare what we heard from the NFIB yesterday to what we're hearing from Delta, just to recap those numbers again. As Lisa mentioned, Ed Bastian, in an interview with Bloomberg, the chief executive of Delta, expecting, quote, no let-up in demand. The numbers we got just moments ago, seeing second quarter adjusted EPS is the range 220 to 250, the estimate 223. And it's the price section, Bramo. Delta's up by close to 5%. This has given a lift to American and to United too.
And this talks about the increase in revenues even with higher commodity prices. That's about a third of the cost of the airplane industry really does come from oil prices. The fact that you still have the ability to pass it along speaks to what we just heard from Francis, which is essentially, okay, screaming, rip-roaring reacceleration in the travel industry for people with discretionary spending. You take a look at small businesses, you take a look at other pockets, it's completely desynchronized to the most degree that she's ever seen in her career.
Well, just sit on that just for a beat longer. Lisa, small business confidence, optimism, just fell to the lowest we've seen in 11 years. We're talking about decade lows. You pair with that employment intentions, they were kicked lower as well, and compare that to what we're hearing from Delta right now, two very different worlds.
And just to sit on that employment component, they basically had the lowest read on planned hiring going back to May of 2020. I'm talking about small businesses. So completely bifurcated. If you're a Fed and you're looking at this, who do you cater to? Do you cater to the reacceleration story at some of the big companies, or do you cater to some of the smaller businesses and regions that are getting harder hit and say, you guys need a reprieve? It is a tough call.
Delta right now doing nicely in the pre-market, up by 4.5%. Let's get you an update on stories elsewhere. Let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Atlanta Fed President Raphael Bostic still sees just one rate cut this year, but says he is open to changing his mind if economic conditions change. Bostic says that the U.S. economy continues to show resilience, but he can't discount the possibility that rate cuts have to move further out. But in leaving himself full optionality, Bostic also added that labor market pain would mean cutting sooner. TSMC's quarterly revenue grew at its fastest pace in over a year. Of course, thanks to the AI boom. The company's value more than doubled since October 2022. Its outperformance also helped enhance expectations that it will return to solid growth this year after slower than expected post-COVID recovery. TSMC said in January that its AI revenue is growing at a 50% annual pace. TSMC is the main chip maker for both Apple and NVIDIA. ByteDance's revenue is surging. The owner of TikTok reported its profits soared about 60% in 2023. It's the first time that it has outpaced Tencent. It's also outpacing Alibaba, too. But the company faces an uncertain future in the U.S. You'll recall the House passed a bill last month to ban TikTok unless ByteDance sells its prized assets. And that's your Bloomberg Brief. John.
Danny, thank you. Some stunning numbers there. Up next on this program, Boeing's deepening crisis.
We're going to approach this, number one, acknowledging our mistake.
We fly safe planes. We don't put airplanes in the air that we don't have 100% confidence in.
That story up next. This is the very definition of snoozy. Take a look at this. Equities going nowhere. Euro dollar going nowhere. The bond market going nowhere. Check back in at 8:30 Eastern Time. I imagine at 8:30 Eastern Time when we get CPI, we're going to start going somewhere.
Literally right now, people are just sitting on their hands. What reason would anyone have to move? The bets are in. You wait for the casino to open. Let's go.
435.97 on a US 10-year this morning. Under surveillance this morning, Boeing's deepening crisis.
I got kids, I got grandkids, and so do you. This stuff matters. We're going to approach this, number one, acknowledging our mistake.
We fly safe planes. We don't put airplanes in the air that we don't have 100% confidence in.
This stuff matters. Here's the latest. Boeing 787 now under scrutiny. An engineer claiming the plane maker took shortcuts to speed assembly of the aircraft, and the issues may, quote, dramatically reduce the life of the plane. Boeing calling the accusations inaccurate. George Ferguson of Bloomberg Intelligence joins us now for more. George, can you talk to us about the allegations, the nature of them, how serious they are?
Sure. Good morning. So they're just emerging, so I think we're just getting our arms around it. What I will say is, they're talking about the mating of the fuselage on the 787. And previously we had Boeing disclose and work with the FAA to fix shimming problems they were having with the 787. So I think the beginning of this, I'm wondering if this is part of that same problem. What I will say, though, is the 787 is an extremely important airplane to Boeing, second most important after the 737. This is an airplane they've collected a lot of orders for lately. They and Airbus are in the marketplace, I'd say, pretty hard right now, working both the A350 and the 787, because these are they're the smaller wide bodies, but the next highest volume programs. If they can push these programs up to higher build rates, that would be a tailwind for profits, for cash flow. So as the second most important airplane to Boeing, very important, very concerning. But again, wondering a little bit if this is something we've already visited. I think that's why the FAA is jumping in pretty quickly to figure out whether this is part of that shim problem Boeing had previously.
Well, let's work through the allegations. So factory workers wrongly measured and filled gaps that can occur when airframe segments of the 787 are joined together. The assembly process could create, quote, significant fatigue in the composite material and impair the structural integrity of more than 1,000 of the wide-body jets in service. So let's talk about the airlines, George. If you're waking up, if you saw this playing out yesterday afternoon, and you're an airline with some of these planes in service, how do you react to this morning?
So again, I think very concerning, but what I'm hearing in what's been released so far is it could affect longevity down the line. So today, I think operations aren't affected. You drive on, but you're concerned about an asset you probably paid $130 million-ish for. You're concerned about, your long-term ability to use that airplane. And again, you got to have another Boeing quality problem potentially on your hands. You'd hate to have that, but you could have that.
It also raises a question about new orders at a time when demand is going through the roof. I mean, we just heard from Delta coming out. Expectations beat Wall Street's forecasts. They also talk about second quarter coming in robust and no sign of a slowdown, typical for this type of season. How much can we expect airplane tickets to go up, prices to go up, just simply because of a lack of deliveries of new planes, lack of capacity, and an incredible amount of demand?
So I think there's a big debate in the marketplace right now if there is a lack of airplanes, if that will filter through into the marketplace. For sure, Delta would be one to gain from the problems at Boeing. If you're a Boeing fleet, you're not getting airplanes as fast as you'd like. You're not going to compete as much with them, so it could help them. What I will say, though, Delta's earnings were nice. But if you look at their yields, it's the price paid per mile flown by a passenger. The yields weren't great. They were actually down year over year. And if you look at sort of the bifurcation of that, if you look at the sort of the basic economy customer, the income for them grew 4% against capacity that grew actually not capacity, but against travel that grew 9%, or revenue passenger miles, which is essentially all the miles they put in the air that were filled. That grew 4% for the basic traveler. It grew 10% for the premium traveler. So what I'm trying to tell you is, it still looks like the basic traveler, there might be too many seats in the marketplace. If you look at Delta's domestic yields as well, price paid per mile flown, by a traveler, those were flat. So right now, what we're not seeing fares rise significantly. We'll see as we get into the summer season. They guided forward. Their guide was an operating margin that would be below last year's operating margin. So while the profit looked good, it beat expectations. What I'm seeing is higher load factors out of Delta, and maybe fares, especially for the basic traveler, aren't as good. They're flat-ish. And they're much better for the premium travel.
This is fascinating, George, especially given what Francis Donald just said about an incredibly bifurcated economy. There's no better microcosm of that than airlines and flying, where basically some people are put in the back and they have to board last, and you don't have any room to put your bags. And then people up front get, incredible meals and have great space, and you pay up for it. Are you basically saying that people in the back are actually becoming much more price sensitive and are having a harder time justifying high costs, and they're seeing less revenue? The people in the front are doing just fine, and that's essentially what you're seeing, and a lot of these airlines are going to count on the people in the front a lot more.
That's what it looks like to me. So, yeah, I think as we go into earnings season, this bodes well for United and American as well. If you've got premium seats, I think you can sell them at good ticket prices. Those folks are willing to pay for comfort. Yeah, and if you've got economy seats, I think it's going to be much more challenging. A lot of them in the marketplace, a lot more price sensitivity. Like you said, I think it goes to that two-speed economy.
So it sounds like they're operating in a more efficient way and not exactly growing. How does Delta grow from here? Do they offer more premium for those high-end consumers?
Well, so we're seeing that across the industry. If you could put premium in an airplane, you are. Some of the ultra low-cost carriers are offering taking the middle seat and blocking it out so they can find a way to create a little more premium and a higher price point for the seat. So that's one of the ways. If you can get more premium in, you do it. The other thing is, if you look at Delta load factors, they were quite nice during the quarter, 83%. So the airlines are kind of pushing getting that airplane as full as possible, right? If you're not getting exactly the ticket price you'd like, if it's a little softer, you just make sure you fill the airplane more. I think we've all seen it when we travel. The airplanes seem to be full every time we pull away from the gate. That's another strategy for improving revenue and obviously improving profitability, because you're putting close to the same cost against a higher revenue base with a fuller plane.
George, this was brilliant. Appreciate the update. George Ferguson there of Bloomberg Intelligence. Delta right now by close to 5%. Just a public service announcement, just quickly. Nobody on the plane gets a good meal. Okay, I don't know where you got that from. No one on the plane.
Okay.
Nobody on the plane gets a good meal. What are you talking about?
Relatively speaking, you're sitting in the back with a bag of Cheez-Its and the kids looking and spilling their drinks.
I'd rather have the Cheez-Its than the slop they serve at the front of the plane.
I thought you like one airline's food. There's one airline.
JetBlue, great food. No, JetBlue, and Air Italia, yeah.
Honestly,
Air Italia,
I see someone with a very small violin over there. Just
JetBlue, great food. Just in case anyone's flying business and they're interested. Look, what we just heard there is really, really critical, and I think you can extend that to the broad economy. Flying up front, flying in the back, two different worlds.
And that really is the perfect microcosm, considering that it's basically a tiered economy for everyone to see. If you're special, privileged, come on up, we'll usher you in. If you're not, you've got to check that bag. You don't have room for that bag. Come last. Your kids, and that's basically where we are. And they have very different realities financially.
This isn't new, though. This is a trend, right? The push towards premium, the higher margins. This has been a story for a while.
This has, which is the reason why international travel has been more lucrative, and the carriers that are less domestic and more international have done better. Just as interesting to see how the bifurcated economy is playing out in real time in the earnings and how they adjust.
A delta in the pre-market doing better than good. Coming up next, in the next hour of Bloomberg Surveillance, Amy Wu-Silverman of RBC Capital Markets, Bloomberg's Enda Curran and Mandeep Singh alongside Tom Titsouris of Strategas from New York City. This is Bloomberg.
This move in commodities, I think, is the real deal now. This has been years in the making.
So the move we got in oil, I think, was very telling from an inflation perspective. We are worried about the surge in commodity prices, but
that will continue and push certain kinds of commodity prices, for example, specifically on copper that we've seen.
We upgraded our view on gold. Why? Because there's now two-way risk on inflation.
Look longer term. The world is changing in a way that the markets right now are not even looking at.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Inflation data 90 minutes away, live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance begins right now with your equity market on the S&P 500 barely positive by 0.1%. A read on US inflation and a big question, just how strong is the US economy? This from Ed Bastian of Delta speaking to Bloomberg, expecting no let-up in demand.
And this really stems from what we just heard from George Ferguson, where it is such a bifurcated economy in so many different ways, splintered in terms of who has money and who is spending and who doesn't, which raises this question, what does this Fed pay attention to? Is CPI going to call their hand when looking at some of the weakness that we're seeing at small businesses with consumer delinquencies and some of the other metrics that people are pointing to?
Delta Airlines are making money. A new range for the second quarter. The adjusted EPS 220 to 250. The estimate 223. The stock, Annmarie, higher by more than 4%.
Higher, but to Lisa's point, the bifurcation of the consumer, the people sitting in the front versus people sitting in the back. I go back to yesterday's small business survey, and the chief economist of that survey came out and said inflation, once again, top of the issue to Main Street businesses. And that goes ahead into the CPI report today.
But this raises this question about whether whether inflation will actually call the Fed's hand, right? I mean, we talk about this strength, pockets of strength, but pockets of weakness. Are they going to be paying more attention to the inflation side of the mandate? Or at this point, is the priority on the strength of the economy and just this idea of employment remaining resilient for longer? That's what I think the market is grappling with. And frankly, it seems like they think that this is a Fed that is much more heavily weighted to the employment picture.
Steve Rashid of Missouri is going to join us in 90 minutes' time. Now, Steve's been saying repeatedly, this Fed wants to cut. Will the data cooperate? Will the data cooperate? And how many bumps in a row can you get before you stop calling them bumps in the road? Are we going to get one too many later this morning?
I love that comment from Priya Misra. Basically, is bump the new transitory in terms of some sort of failed concept. The issue is right now the market is set up for a more bearish tilt. It's set up for this idea of inflation running hotter, although along with strength. What is the biggest surprise to this market? What is the potential bigger reaction if there's an upside surprise or a downside surprise? What I've been fascinated by is I think it's a downside surprise because everyone's going to say this is an excuse for the Fed to go. That's amazing. This is the all clear to them, even if inflation is still running hotter than expected. But if you look at the positioning, it seems like that's the balance of risks to rally further.
Well, as you've said, you always have to look at it relative to the positioning. And we've been talking about how short maybe things are in treasuries at the moment. If you want the estimate, we just put them on the screen. We can do that again. 0.3%. Stripping out food and energy month over month is the estimate. The median estimate in our survey here at Bloomberg, the prior number was 0.4. Equities, your scores look like this on the S&P 500 this morning. Equity futures just about positive. On Monday, we were down a little bit, then up a little bit on Tuesday, now up a little bit on Wednesday. Really, really muted price action going into this inflation data. Your 10-year, 435.57. Yields going absolutely nowhere, and the euro basically unchanged against the dollar at 108.63. Coming up this hour to discuss, Amy Wu-Silverman of RBC on why the left tail is waking up. Mandeep Singh of Bloomberg Intelligence as ByteDance reports a 60% profit surge, and Tom Titsouris of Strategas on what Washington and the Fed are aligned on. That's a conversation, by the way, you do not want to miss. We begin with our top story. Stocks holding steady in the United States ahead of CPI data later this morning. Amy Wu-Silverman of RBC says enthusiasm is beginning to fade. The left tail is starting to wake up. When we say left tail, we are referring to the bid for downside protection or the demand for hedging. Amy's with us here in New York around the table. Amy, good morning to you.
Good morning.
How are you interpreting this shift? Because last time we spoke, it was a very different story.
It was a very different story, and might I add, it was actually the peak of enthusiasm when we actually look at the call demand on NVIDIA as a proxy for AI enthusiasm. We essentially went to the 100th percentile where we were when we last spoke to about 40th percentile now. And what it really tells you is this enthusiasm is still there, but it's waned substantially. And then as you mentioned in the quote, the left tail is picking up. We're finally seeing options markets say, maybe there's something to hedge out there. And to be clear, we haven't seen that since 2022.
So I'm trying to work out, is this anticipation of something or just the price setting the narrative? Because since we last spoke, since March 25th, again, NVIDIA is down by something like 11%, down double digits. So clearly the price has moved. What do you think they are anticipating?
And that's a great question, because sometimes the question is this really a coincident indicator, or is it a situation of the tail wagging the dog? And what I will tell you is in other situations where NVIDIA has sold off, for instance, or AI has taken a pullback, that enthusiasm has not waned. So to me, what is different is the positioning has stayed pretty stable in the last few years. This is the first time where we've seen price action change and folks say, well, I'm not going to jump in the pool again. To me, that nuance is very important.
Is this bearish or bullish? And I say this because on one hand, you could say this is on the margins, not that great for the high flyers in AI. But if you're seeing it broaden out and people actually are getting more confident in the rest of the sectors, it's kind of overall a positive sense. Is that what you're seeing?
Yeah, and the problem is, Lisa, that's really complicated. We're not sure, but here's what I'll tell you. When you see the market broaden out, we would also expect to see this translation to something like IWM, for example, which would be a proxy of the market broadening out, and you probably see that call demand transfer over. We've seen that a little bit, but actually what we have seen more of is that downside picking up. So again, enthusiasm has waned. That has not happened in the past, and we also haven't seen that transfer. So that's what I'm really watching for in terms of, is this breadth going to continue? The options market is far more concerned that there's actually just general pullback.
So this is a highly complex time, as we've been hearing from everyone, and especially as we head towards CPI coming out in just a little less than 90 minutes. What do you think the market is better positioned for? An upside surprise or a downside surprise? Is this a market more kind of prepared for inflation running too hot or cooling rapidly with the potential for some maybe weaker growth?
So this is the first time the market is more prepared for the downside rather than the upside in terms of the market itself selling off. So, like a print being hotter than expected. But what I think is interesting about that is it's not just that. The actual magnitude the market is expecting from CPI is one of the highest it's been. We measure that through the straddle pricing in options itself. So just that magnitude of the move is one of the largest we've seen out of all the CPI prints we've had.
Also in the options market, people are hedging that with gold, correct? Is it just an inflation call, or are you seeing people buy into that for other reasons?
So that's another interesting pocket of the market. One thing we've been talking about in terms of the options narrative is, prior to this left tail waking up, one thing we've said is we know people are worried. Where is this worry being expressed? We've seen it in gold. We've seen it in energy due to geopolitical risks. I think this Asian bank narrative is some of it, but I also do think it's an outlet for expressing inflation concerns. And when you see that historic pickup in call skew, you're essentially saying, if you own gold, that payout is at a level that is extremely attractive relative to history, and we continue to see that climb. And we just think it's an outlet that is expressing it when the left tail has not been working in the market itself.
Can we stay on commodities? Just how consensus has the long energy story become? Mike Wilson, Morgan Stanley, overweight energy, overweight commodities over at JP Morgan. Marko Klanovic was reading Lori Calvasina this morning.
Yes.
That note, sticking with energy. How consensus is that view now?
Look, I think obviously this is a train people have gone on, but as Annmarie would probably tell you, it's very hard to price that unknown that is coming from the geopolitical risk. I think this is something that investors struggle with. Last Thursday's price action, I think, was a really good example of that, which is, if we get into an escalating situation with Iran, like how do we price that? How do we price these unknown unknowns? Which is why I think that bid continues. And then obviously you have this valuation argument that continues to hold too, which is why I think people continue to stick with that.
When you look at the options pricing, though, we're seeing, at least I'm seeing a lot of people buying 125, 135 calls on oil. How high are people actually expecting this peak in the summer could potentially get?
A good analogy to that, Annmarie, is I also see people buying 30, 40 strikes on VIX itself. And the way I would think about it is, do they think that we're going to get there? No. But if we do get there, that payout is really, really attractive. You get that convexity immediately. And I think that's what people are actually saying. They're saying if we get some situation that is unanticipated, we know those tail events are relatively inexpensive. We're getting extremely attractive payouts, and that's what we're playing for.
One thing that I keep hearing from you is that there has been a shift, whether it's with AI stocks, whether it's with just the sort of preparation for downside from this hotter than expected CPI print, which people are anticipating. What does this tell you about inflection points, just based on your history, when you start to see derivatives trading sniff out something that's slightly different?
Yeah, and you know, I keep harping on this, which is that this is the first time the derivatives market has said something different when we've seen momentum go this way, because I think I was here like right prior to March 18th when that NVIDIA conference was. And the one thing I had said then is, look, there are these clearing events where either momentum continues or it stops. And when we see that shift in momentum from the options market itself, that has typically been a really interesting leading indicator. And we have not gotten that. That's the one difference between now and over a month ago.
Deeply thoughtful stuff, Amy. Thank you.
Thank you.
Amy Will-Silverman there of RBC Capital Markets. I don't know about you, but what I heard there was basically economists are looking for 0.3, but the market might be positioned for 0.4.
Which is the reason why if you get 0.2, get ready for a rip-roaring rally because all the shorts are going to get squeezed out. Essentially, this is a unique moment, though, as we just heard from Amy, that this is the first time in recent memory that this is a market more prepared for an upside surprise and the downside that comes with it from the CPI print rather than maybe a downside
Which
surprise.
is why we've said a few times on this programme, in line might be the new beat when it comes to inflation and the way this market's set up. The way we're set up this morning, equity futures positive by 0.1% on the S&P 500. Let's get you some stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Fitch has cut its outlook for China's long-term debt from stable to negative. The ratings agency says rising economic uncertainties have eroded fiscal buffers. Although Fitch sees government debt increasing in coming years, it did affirm China's A+ rating. There are more signs that Apple is trying to push beyond China. Bloomberg has reported that the company assembled $14 billion worth of iPhones in India in its last fiscal year. That's double the production from the year prior. Sources say the tech giant now makes as much as 14%, or about 1 in 7 of its marquee devices in India. More trouble for Boeing. The FAA is investigating whistleblower complaints that the company took shortcuts to ease production bottlenecks on the 787 Dreamliner. The plane maker says the claims are inaccurate and do not represent the work it has done to ensure the safety of the plane. Shares of Boeing so far this year are down 30%. Scrutiny of manufacturing practices have been building since the midair accident in early January. That's your brief, John.
Pretty concerning stuff, let's put it that way. Danny, thank you. Earlier on, I was promoting that interview with Tom Tsatsouras of Strategas. And if you are just joining us, just listen to this line. Washington committed to run the economy at full employment of all costs until the election, and the Fed is looking for every excuse possible to cut to aid this cause. As you said, these are kind of things that people whisper. You know, they have quiet conversations about. The cynical people amongst us, skeptical of the objectives of the Federal Reserve.
Well,
they're saying it out loud.
Well, and Tobin was saying this is an active conversation in terms of policy, and yet there really is this ultimate question: where is the mandate right now on keeping inflation down to 2%? A lot of people are saying that's squishy. In terms of employment, that's a really important one, and I think that's really where the mindset has shifted.
We'll have an active conversation later this hour. Don't miss it. Up next on the program, the Biden administration taking on China.
China's whole strategy is to isolate the Philippines, isolate Australia with their economic coercion, isolate Japan. Our strategy is to flip that script and make the isolated party China.
That story up next, live from New York this morning. Good morning.
Season is coming.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
It all starts Friday on Bloomberg. Context changes everything.
1 hour, 15 minutes away from inflation data in America. Your equity market pretty much dead flat through the week going into it. Equity futures this morning just about positive by 0.1%. Yields pulling lower by a single basis point. Things are warming up. 434.97. I'm doing my best to sell it.
I was about to say,
it's been so quiet so far this week. It's going to pick up at 8:30 Eastern Time. Under surveillance this morning, the Biden administration taking on China.
China's whole strategy is to isolate the Philippines, isolate Australia with their economic coercion, isolate Japan. Our strategy is to flip that script and make the isolated party China. They're the ones that are isolated in the South China Sea as it relates to the Philippines. They're the ones that are isolated when it comes to trying to use economic coercion to coerce Australia to change their posture. And they become the isolated party.
Here's the latest. President Biden looking to crack down on China's isolationist tactics, hosting the prime ministers of Japan and the Philippines at the White House for a state dinner tonight before a summit tomorrow. Andrew Curran joined us from Washington for more. Andrew, I want to go through this line from the ambassador just then. Our strategy is to flip the script and make the isolated party China. And how is that going down in China?
Well, I think it would be a big ask to isolate China economically from the world stage and even militarily. I mean, that summit today here in Washington with Japan and the Philippines tomorrow is all about coordination and cooperation on the security stage. But remember, that's a handful of nations. Asia is much bigger than the Philippines and Japan and Australia. There's plenty of courting going on China's side too, and I think it's far too early to say there's any kind of isolation going on. At best, the kind of tangible details that might come out of this meeting between Japan and the US today look fairly modest. It's all about cooperation. There's going to be some additional cooperation on allowing US naval vessels to be repaired or maintained in Japanese shipyards, for example, more coordination around technology and AI and the like. And obviously all about building up this sort of drumbeat of support against China's claims over Taiwan and tensions in the East and South China Sea. But all of that, as I say, that's cooperation and coordination. I think if you're talking about isolating China, that's a whole other story altogether.
But when you look at what they might do in terms of defense, and this comes on the heels of already naval exercises between the Philippines, Japan, and the United States, that was a huge warning sign, really, to China. Is this their diplomatic way of pushing back even more on China, especially in the South China Sea?
It very much is, and there was a White House statement, Annmarie, making the point that they want to send a signal that China needs to know where the limits are for its aggression and for its claims in the East and the South China Sea. And those drills, as you mentioned, very unusual with Australia, the Philippines, Japan, and US this week, sending a clear signal. And as I say, these talks with Japan today, and then of course the summit with the Philippines tomorrow, that's all about creating this idea, the optics that there is an alliance, that there is a pushback among allies against China's claims in that part of the world. But as I say, China itself does have its own allies in the region too. China remains the most powerful economic force in that region. So it's not like whatever comes out of the talks today and tomorrow is going to result, in China necessarily taking a step back.
Ambassador Rahm Emanuel also talked about this multilateral approach, whether it's defense, whether it's economics. How does the United States do that when the president has come out in opposition of Nippon Steel taking over U.S. Steel, even though Japan says this would be one way to fight China?
Yeah, this is the steel elephant in the room, as my Bloomberg economics colleagues called it. I mean, there's politics and economics here, Annmarie, as you know. The economics of it are the US is asking allies to do more to restrict technology into China and to do more to help it in its pushback against China. But here you have, of course, Japan trying to buy that steel plant in the US, and the president giving his disapproval of it. It hasn't been blocked outright, but certainly giving his disapproval, which was unusual. Economics of that suggesting what signal does it send about the US attitude towards foreign investment here, and especially among allies. But the politics, as you know very well, are also pretty real too. This is about a very sensitive sector, the steel sector, in a very sensitive electoral state, Pennsylvania, in a very important year, which is the election year. So there's no doubt that politics has obviously trumped what is going on here. The question remains is how much wider damage does it do to the US standing in kind of the world of free trade. Chinese state media are certainly dining out on it, but there is also a view that this will be looked at through the political lens. So Prime Minister Kishida, for example, he has said he doesn't plan to raise it in his talks with President Biden today.
We started by talking about the concept of isolating China and how it's probably being received. Some of Rahm Emanuel's more fiery words than, say, Janet Yellen. I am curious about the economics of this at a time where you see Apple just quietly shifting production out of China and into India, at the same time that they don't really sell in India because India is flooded with cheap Chinese phones that really dominate the market. How much has this become part of the issue for the United States that China is flooding the market globally with cheap goods that it wants to sell, not just to the U.S., kind of crowding out competition elsewhere?
It seems to have become the topic of the moment. You know, the main theme, the main messaging from Secretary Yellen's trip to China last week was all about the idea that China is making too much excess produce, and it is, as you mentioned, Lisa, dumping it on global markets at cut prices. And interestingly, during that speech, during that visit, Janet Yellen made the point this wasn't just a threat to US factories and US workers. She made the point it was a threat to workers around the rest of the world too, so trying to drum up that support. We do have, of course, the big IMF World Bank meetings here next week when finance ministers from every corner of the world will be in Washington, D.C. And it will be very interesting to see then what kind of support, which countries do weigh in behind this US-led complaint that China is now stoking a kind of a new China shock with this export of its excess capacity to key markets around the world. So far, at least, I think the argument hasn't really lit up or taken off globally. It's mostly a US-led complaint against China, but we'll see if that changes next week and in the months ahead.
And it also raises this question of whether countries have to choose alliances, whether to go with the United States in this concept of avoiding goods that are cheaper, but from China in order to get in good with the United States, or whether they can kind of just all move to their own music, and if they want cheaper goods and import them from China, go for it.
Well, this is the big economic trade-off. I mean, there's no doubt that China has, of course, been a source of cheaper labour, cheaper manufacturing, lower environmental standards. That's why the world's factory base ended up being based there. And at the flip side, consumers ended up with cheaper clothes, cheaper goods. Factories bought cheaper steel, you name it. And I think when it comes to making choices, countries, especially in the global south, to use that term, they're not in the mood for making a choice between either the US or China right now. They're happy to do business. We saw those comments last week from Argentinian president to us, making the point that companies will continue to do business with China as they so wish. So I think if you're looking through this in a binary lens of are you with the US or against them, at least on the economic front, I don't think it's not yet how it's playing out, that's for sure.
Totally missed the boat. And there's something about this that just seems so stale to me over the last week. There's nothing fresh, nothing new in this whatsoever. And let's just dissect the language again. China wants to isolate Australia. They want to isolate Japan. We want to flip the script and make China isolated. Now, do you remember TPP, Trans-Pacific Partnership? Who did that include? Japan, Australia. Who didn't it include? China. Wasn't that the whole plan 8 years ago? And are we just trying to sort of refresh that all over again?
Yeah, quite right. There is a lot of repetition and on the loop in a lot of this, John. And it's also true, by the way, of the overcapacity debate. I mean, you mentioned the point of the TPP. That was sold by the US administration at the time as a kind of a grand bargain to build this big trading network in the Asia Pacific, of course, without China. That was discarded by President Trump. And here we are today. I think by all accounts, if you look at what's happened over the past few years, China has grown its export base. It has grown its economic trading clout around the world, and it certainly continues to court, as I say, the global south. Remember that BRICS expansion last year? So even as the US build its alliances and as it puts on today the portrayal of the alliance with Japan and the Philippines, China too is building its own alliances through its own trading networks, be it the BRI, be it BRICS, be it whatever else. So as I said earlier, it's not as simple as saying China's being isolated. They're continuing to build their alliances too.
Well said, Ender. Good to catch up with you. Ender Curran down in Washington, D.C. Of course, the former President Donald Trump blew up TPP when he came into office. There's nothing new about any of this. What's new? What's new? Hardly anything. I'd say 8 years ago, what happened? The electorate said no. And they said yes to Donald Trump. And ultimately, no one can campaign on these issues anymore going into November.
It's why this Nippon Steel deal will likely get blown up, especially ahead of an election, which is why when I talk to people, they're saying maybe we're not going to get any sort of consensus on what to do with this deal until after November 5th.
Strong words, but sort of back it up with policy. What are you doing about it?
And that leads us to the expected tariffs that are probably going to come before the election and other things. Again, How much daylight is there between the two views of the two candidates, and how do CEOs get ahead of something that seems almost like an inevitability?
Yeah, maybe not much. Coming up on the programme, ByteDance's profits surging roughly 60% in 2023. Mandeep Singh of Bloomberg Intelligence up next. I imagine in about 60 minutes and 30 seconds, this board's going to look very different when CPI drops and people start to actually do things. Equity futures right now on the S&P positive by 0.1%, totally unchanged on the Nasdaq, and we're positive by 0.25% on the Russell. If you switch up the board and get to the bond market, we've had some price action there over the last week for sure. Got very, very close to 480 on a 2-year. We backed away since then to about 473.44 on a 10-year, around 440 for a heartbeat, couple of seconds, back down to about 435. 434.97 this morning, down a single basis point, and perhaps encouraged by what's developing on this board in commodities. Brent and WTI just pulling back from the highs of the year. Brent crude back below 90, Lisa, 89.97.
A bit more of a sense of ease maybe in the Middle East in terms of maybe some sort of resolution or a lack of an Iranian escalation akin to what people had been thinking. That said, there is a new bull bet, and we have been talking about that extensively, where the new consensus trade, some might argue, is with commodities and oil in particular. And if that's the case, how much does this really have fuel to go further, especially if there is some sort of disruption?
Went through all the calls, and this bull bet is pretty clear. Overweight commodities, Marco Kolanovic, Mike Wilson, Morgan Stanley, overweight energy, Lori Cavacina overnight, sticking with energy. Can we just talk about the Middle East? Is quiet bearish? Because what we've got is silence, a bit of quiet over the weekend. I think going into the weekend, what are we waiting for? A response from Iran. Really sort of gauge the prospect of direct confrontation between Israel and Iran and the prospect of that spreading across the region, because it's been quiet over the last few days. I think crude sold off a little bit, but is quiet constructive? Don't we still have in front of us the very real prospect of confrontation between those two countries?
Absolutely. In the last 48 hours, Netanyahu has come out and said he has a date in mind and when he wants to go into Rafah. So the past 48 hours, we also have seen, though, humanitarian aid go in. Potentially that's giving people some ease, oil pulling back. But this story is far from over.
89.92 on Brent. Positive this morning, at least, by 0.6% on WTI. 85.73. Under surveillance this morning, just under an hour away from the US CPI report, following hotter than expected prints to start the year. The median estimate in Bloomberg survey calling for a 0.3% monthly rise in core CPI. That's a slight tick down from a month ago. Now, you've got two things going on here. The survey, the median estimate in our survey, and what we're priced for. And Lisa, I think you've done a pretty good job over the last 90 minutes or so explaining the difference between the two.
Basically priced for an upside surprise, more around the 0.4%. The idea that likely this inflationary story is a bit stickier and the Fed's going to have to push back when they cut rates first. Here's the question, right? Does this basically set up the market for a much bigger reaction if we get a downside surprise or even an inline number than we would otherwise expect? Bonds ripping, stocks ripping. Or are we looking at, if we get that 0.4%, the narrative shift that we heard from Amy Wu Silverman that could be a real pivot point?
If we do get, though, within expectations, I love Stephen Stanley overnight at Santander because he brings up Governor Waller's point that they're going to need 2 consecutive months of that benign inflation story to potentially consider cut. And that gets right up to the June date. So what he's talking about, a lot of analysts are now starting to really spin the results. This idea of 0.3% month over month is basically good, even though we'd have to see that again before the Fed considers.
This is why it's lose-lose. Tobin Marcus said this over at Wolf Research in the previous hour. This is why it's lose-lose for the Fed. If they have to wait, they get accused of waiting too long. They go too soon, they're too soon. If they're too close to the election, it's politics. If it's after the election, they're against the person who was running and didn't win. Like, this is the problem, repeatedly.
Okay, well, I'll take it a step further. Basically, if they're doing an okay job and there isn't anything dramatic to talk about, people need to do something with their day all day long. So you've got a bunch of smart people who are overanalyzing themselves into a tizzy and trying to figure out every which way that they can spin it that is potentially problematic and critically thought. So to me, that's also what's going on. To a degree.
It is CPI Wednesday, and that happens a lot. Let's talk about Delta. Shares of Delta rising in the pre-market. The airline reporting first quarter earnings that topped Wall Street estimates. Delta also coming out with strong guidance for the second quarter on the back of increased business travel and steady leisure demand ahead of the start of summer. That stock is up by close to 4%. And Lisa, some pretty strong words coming from Ed Bastian, the CEO.
Basically coming out and saying that they don't see any end in sight to the demand, and that, frankly, even though you typically do see a lull in terms of travel ahead of of the summer, you're not seeing that. The fact that for second quarter, they're expecting the higher end of the estimates, just to me indicates both the strength in the underlying consumer, but also what we were talking about with George Ferguson, the bifurcated consumer, the fact that the people at the front of the bus are doing pretty well, the people at the back kind of pushing back.
And it's the people at the front of the bus, front of the plane, maybe it's an Airbus, front of the plane that is basically propping up all of this when it comes to the revenue and profit that this airline is making. And potentially we see United Airlines and American set to come out, their stock being pushed higher by this. Probably similar stories.
It's been the trend for a long, long time. Let's talk about who's making money. It's ByteDance, reporting a profit surge of roughly 60% last year, underscoring the strength of the social media app. The company facing an uncertain future in the US, though. As you all know, the House passing a bill last month to ban TikTok unless ByteDance sells its prized asset. Joining us to discuss is Mandeep Singh of Bloomberg Intelligence. And Bramo's going to do a little dance for you in a moment. She was doing that off cam as we're introducing that segment.
It was really good. It was so good.
New TikTok
fantastic.
star.
Okay,
Fantastic. Mandeep, strong numbers from ByteDance, strong numbers from Taiwan Semi as well. Decent numbers out of Asia when it comes to tech. What's behind it all?
Well, so different story. I think in the case of ByteDance, probably it's the strength of their domestic app and, you know, how the ad spending is probably bouncing. I don't think it has to do with the TikTok US business as much as it has to do with the domestic business. In the case of TSMC, it comes down to, you know, every AI player, when it comes to fabless chip makers, has to go to TSMC. And they have the pricing power. And I would say they haven't flexed it as much as NVIDIA has on the actual chip that they are selling. So in the case of TSMC, they've talked about a 50% CAGR for their AI business over the next 5 years. So here's a company that every hyperscaler would go to, every fabulous chip maker, whether it's Apple, NVIDIA, AMD, they have to go to. And I think you have clear kind of line of sight in terms of how this business could grow 50% over the next 5 years.
So as you know, TSMC has a working relationship with NVIDIA and with Apple as well. Can you read into these numbers overnight and read into strength elsewhere as well? Can you look at Apple and say, actually, maybe things aren't too bad?
So in the case of Apple, yes, I think it bodes well for a refresh cycle. We still don't have clarity on what they are doing on the AI side. A lot depends on what they announce in June. But clearly, the data center spending is holding up very nicely. And when you look at the numbers that Google and Amazon and Microsoft have talked about in terms of their CapEx going up for this year, that all is going towards buying NVIDIA chips as well as going directly to TSMC to make their own chips, which is what Google indicated yesterday at the Cloud Next event.
There's a sort of larger question here that was introduced yesterday when Intel came out with the proposed idea of another AI chip, which is how saturated is this market? Is this something that NVIDIA can dominate and others can grow? Or is the entry of new players potentially problematic?
Well, so right now I can tell you the market is supply constrained. And we have gathered that from a number of participants who keep saying NVIDIA chips are still in short supply. The H100 and the A100, forget about the new line that they are coming up with. So clearly, given the supply constraints, I would say this year, you're not talking about, Intel making a dent. And if, Google is making their own CPU, that's going to hurt Intel. Intel is the dominant player when it comes to the CPU market, the traditional CPU market. So if every hyperscaler is making their own CPU, that hurts Intel, that hurts AMD. It helps the building block companies like ARM, like Broadcom, like Marvell, but not the chip makers in the CPU space.
With TSMC, how much of a clutch do they have? I mean, we've talked about possibly diversifying away from Taiwan and being able to see production in other places. Is that just not happening because TSMC is so dominant and doing the job that they're doing?
They are, and they are diversifying. I would argue they have started a new fab in Japan. That's live. It's actually manufacturing chips. So clearly, I think that diversification play is happening, albeit in the US, it's still slow. They announced a new round of funding from the CHIPS Act. So clearly, I think they still have the secret sauce when it comes to the advanced node manufacturing. Intel, they touted, the performance of their Gaudi chip yesterday, but they haven't announced a large company that's buying chips from Intel for training and inferencing in AI. That's the proof point that Intel needs to give to convince investors, okay, they're right up there with competing with NVIDIA.
Mandeep, I like to talk about ByteDance, where John started, just because this is the first time it's overtaken Tencent when it comes to revenue and profit. And you look at the U.S. business, this e-commerce business that TikTok is trying to grow. Yeah. They want to grow it tenfold. This is going to be very lucrative, but how existential is it for ByteDance, given all the politics around TikTok?
Well, I would be very surprised if TikTok is able to get into e-commerce in that big of a fashion under the current ownership with ByteDance, because you're talking about, capturing a lot more transactional data, and I can't see, regulators allowing that to happen.
But what's there now stopping it?
Well, I mean, they have to build a delivery business. So think about how Amazon goes about fulfilling the e-commerce side of things. They have their own logistics arms. So TikTok doesn't have anything like that in the US. They have to partner with somebody, a large e-commerce player or a large delivery player. And for that to happen, I can't imagine any company announcing a partnership with TikTok, given they're still owned by ByteDance.
Maybe they'll have to wait till after November. But it sounds like what you're saying is that there's now a ceiling, really, on how much TikTok could grow.
In the US. Outside the US, they've got a number of apps that continue to see very healthy user growth. They are doing very well, domestically in terms of the ad business. So clearly, when you look at companies like ByteDance, you have to do a sum of the parts analysis and look at, how each of the app is contributing to the overall business.
Hey, Mandeep, appreciate the update. Thank you, sir. Mandeep Singh there of Bloomberg Intelligence. Equities at the moment positive by 0.1% on the S&P 500. Inflation data 50 minutes away. Let's get you some stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. At least 3 people are dead after an explosion at a northern Italian hydropower plant owned by Enel. The company said a fire had impacted a transformer without providing further details. Enel, Italy's largest power supplier, shut the plant down immediately for safety reasons, but local power supply was not affected. Atlanta Fed President Raphael Bostic still sees just one rate cut this year, but says he's open to changing his outlook if economic conditions change. Gave himself full optionality, saying that the U.S. economy continues to show resilience, so he can't discount the possibility that rate cuts have to move further out. But Bostic added that labor market pain would mean cutting sooner. BMW sales of fully electric vehicles jumped 41% in the first quarter, outperforming rivals Tesla and Mercedes and contrasting with a broader slowdown in demand for EVs. Mercedes reported EV sales that fell 8% in the first quarter, while Tesla recently reported its first year-on-year sales drop since 2020. EVs made up roughly 15% of BMW's total deliveries last year, with that figure expected to rise to 20% in 2024. And that's your brief, John.
That's a rare piece of good news. Danny, thank you, because it's been bad news in that space over the last month, that's for sure. I've been sharing this quote with you all morning. It comes from Strategas and Tom Titsouris. Washington committed to run the economy at full employment at all cost until the election, and the Fed looking for every excuse possible to cut to aid this cause. Up next, the Fed getting pulled into politics.
If they cut in June or July, they'll be criticized for cutting too early and too much. If they cut in September, they'll be criticized for cutting too close to the election. If they wait until November or December, they'll be criticized for holding rates high, sort of longer than necessary in a way that hurts Trump.
That active debate up next. 46 minutes away from CPI data in America. You know the numbers by now. Looking for an estimate, 0.3%. That's your estimate in a median survey, median estimate in our survey here at Bloomberg. The previous read, 0.4. Equity futures positive by 0.1% on the S&P. Yields a little bit lower by a single basis point on the 10-year, 434.77. Under surveillance this morning, the Fed getting pulled into politics.
Powell's very clear political incentive is to ride off into the sunset as the person who defeated this outburst of inflation. If they cut in June or July, they'll be criticized for cutting too early and too much. If they cut in September, they'll be criticized for cutting too close to the election. If they wait until November or December, they'll be criticized for holding rates high, sort of longer than necessary in a way that hurts Trump. So he's damned if he does and damned if he doesn't, I think, in terms of the political incoming he's going to face.
Here's the latest this morning. Less than 1 hour away from the March CPI report, investors looking for insight into the Fed's path forward following hotter than expected inflation prints and some pretty strong job numbers. Tom Titsouris of Strategas, a Baird company, writing this: Washington is committed to run the economy at full employment at all cost until the election, and the Fed is looking for every excuse possible to cut to aid this cause. Tom, we've been looking forward to this all morning. Good morning to you.
Good morning. Thank you for having me.
What tells you, that last line, I think this is really important, what tells you the Fed is looking for every excuse possible to cut to aid the cause of the White House?
Well, because simply put, we're still at full employment. Inflation is still well away from target. And the Fed is already talking about rate cuts, penciling in 3 cuts for the full year. And on the speaking circuit, you're having Fed leaders talking about rate cuts, the need to slow balance sheet reduction. All of that is indicative of a lean towards wanting to ease sooner rather than later.
Do you think that's a mistake, possibly?
Well,
why is it a political bias?
Well, it's definitely a mistake if we continue to be at full employment and we continue to miss on the inflation mandate, because simply put, it's unprecedented to be easing this aggressively when you're already at full employment and inflation is already too high. So by definition, that's a policy mistake. But do they know something different, or is it a political bias? We don't know that right now. We don't know if they are seeing something that's making them very concerned. They could be concerned about financial stability, which is not necessarily politically biased in general, but has political ramifications. So there's a lot that they could be seeing that's worrying them that is not necessarily a political bias, but it's very suspicious at this point.
Okay, so to be clear, you hint out that this is sort of a political bias because you can't find the justification in the data. Is that basically your conclusion?
Yep, that's what we have to conclude. That's the most simple conclusion. Now, as I said, there is another possible conclusion here, that we have a Treasury deficit that is just gargantuan and is going to become progressively more difficult to digest. That causes not just political consequences, but financial instability. So we know very well that as the reverse repo facility shrinks towards zero and T-bill issuance ramps up again later this year, you're going to start pulling money out of bank reserves. If the Fed doesn't ease into that, there's pure liquidity drain. You can't run $2 trillion deficits year after year, even if you're the world's reserve currency. So there's a financial stability risk here that could be motivating the Fed as well.
I love this. You're saying all the quiet parts out loud. Number one, potential political motivation by the Federal Reserve or political bias. And number two, this potential that the deficit is hanging over their head and they want to ameliorate some of the interest payments. What about this argument that you are seeing real pockets of weakness in particular segments of the population, that you are seeing small business confidence coming in at the lowest level going back more than 11 years, that you are seeing delinquencies pick up, that you are seeing certain segments really hit hard with rates where they are?
Oh, I agree with that. And that's why they shouldn't have raised rates the last 50 basis points. They should have run off the balance sheet at a quicker pace. Because what you're doing is you've seen the Fed squeeze the life out of Main Street USA by raising the Fed funds rate. But part of the reason why inflation has remained persistent is because they have not used the balance sheet aggressively enough, and the world's largest spender, the U.S. government, has not seen any constraints on it. If they had used the balance sheet more aggressively, there would have been less strain on Main Street and more strain on the big spenders.
Hold on a second. You're saying that they should have disciplined the government by not necessarily helping them?
Well, they should have recognized where the inflationary pressures are coming from, where the excess aggregate demand is coming from. It's coming from high net worth individuals. It's coming from mass affluent households. It's coming from government spending. And so the way to rein that in, to keep that inflationary pressure from continuing to push the economy beyond full employment, is to put upward pressure on those borrowing costs. What the Fed has done has put upward pressure on Main Street USA, small businesses. I like to use the stereotypical grocery store owner. They've seen bottom-up pressure from insurance costs, energy costs, costs of goods sold, and bank lines of credit. They carry their inventory with bank lines of credit. They've seen it go from 3% to 10%. Pure bottom-up cost pressure for these guys. If you look at large companies, if you look at the federal government, they've seen their borrowing costs rise 200 basis points, maybe. They maybe in some cases have gone negative. You look at large cap tech companies that actually have negative net interest margins, or I should say positive net interest margins. They're looking at negative borrowing costs on net. So there hasn't been enough tightening there.
Tom, what do you think is more important than fiscal policy right now or monetary?
Well, in terms of the labor market, fiscal policy. So we're looking at stimulus coming out again in 2024, very likely targeted towards the middle to third quarter of the year. And that's more important for the labor market because, simply put, it's designed to keep the consumer spending. When you're talking about financial markets, obviously monetary policy is what's most important. But monetary policy, too, is being blurred by the enormous amount of cash the Treasury has and has been slowly pumping into the economy. So right now we're actually in we'll call it a liquidity air pocket. As households and businesses pay their taxes, Folks are pulling bank reserves, they're pulling their money market funds, they're selling their muni bond funds to pay the government. That's pulling liquidity out of the market. That's one reason why we've seen the equity markets off and you've seen bonds off. But as that results in a cash hoard by the Treasury that is later going to come out this year, liquidity will matter. And if the Fed eases into that Treasury cash push, you're looking at essentially an ocean of liquidity coming into financial markets from, we'll say, May until Election Day.
If we could talk about the election, this idea you have that the Fed wants to aid that course of what we're seeing, potentially keeping Biden in the White House, how much consensus does Powell need if he wants to make that cut?
Well, first of all, I'd stop short of saying they want to keep Biden in the White House. I think they want to keep financial stability for many reasons, one of which is it creates political stability. But I think their primary motivation is still financial stability. I don't think they care about one winner of the White House or the Senate or another. They want the stability that comes with a stable Treasury market. Unfortunately, that has huge political ramifications. So I do say that, and I forget the second question. So,
well, how much consensus does Powell need? Because the stakes are very high, and it is going to be seen for many people through the lens of politics.
Well, that's a great question. How much do they need? How much proof do they need? Well, they've already got proof that they haven't tightened enough, that there's still too much inertia to inflation. So how much more proof do they need? Will today's CPI give them proof that they cannot cut 3 times this year? It should, if that comes in hot. So I do believe that if we get a hot CPI, if that comes in, let's say 3.5 on a year-over-year basis, 0.4 or higher month-over-month, that should take that June rate cut off the table. But just as importantly, that should take an announcement for a May taper, or starting in June, off the table as well. That should be enough. To me, that should be enough. But I don't know if that's enough for the doves in the Fed to continue to pull back and say, okay, we got to wait another month or so. But that, to me, should be enough. That should be enough for Powell to say we have too much inertia to this inflation still. It's still too sticky.
Tom, are you saying they're willing to trade price stability for financial stability?
Unfortunately, I do think if there's been one casualty of the Fed over the last decade plus, before I'd stop short of saying their political independence has been sacrificed, but I do think their focus on dual mandate of full employment and price stability has been sacrificed because of an excess focus on financial stability, which oddly enough is not one of their legal mandates, and two, is probably the least achievable of these sort of philosophical mandates. They really can't achieve financial stability, but there's been such a laser focus on it from a regulatory standpoint to simply a monetary policy standpoint, keeping financial markets stable.
These are some big statements, and I'm sure you understand that. So if the Federal Reserve is willing to do that, not for me to challenge, that's your belief. You also believe that Treasury supply could become a financial stability risk as well, a global financial stability risk. Can you tell me what on earth to do with Treasuries right now? Because if I was listening to this, I'd really be struggling. What do I do?
Well, we wait for the CPI number, because that is going to tell us which direction the Fed is going to go in the next few months. But more importantly, it's also going to tell us where is nominal growth going to be, and that's a good benchmark for 5-year and 10-year treasuries. So that's the first point, I'd say. But what do you do with treasuries? You do what you have to do. Treasuries are the gold that backs up the global financial system. You can't really liquidate them completely. So you've got to hold them, whether you're a bond fund, you're an equity fund, you're a bank. So you can't migrate away from them entirely. So you've got to be tactical right now. We're in an environment where, depending on your mandate, depending on what you do, you have to hold treasuries, but you don't have to hold duration. So you can leg in and out of duration, increasing duration when the market gets sold off. And when we start to see 5- and 10-year treasuries approaching where nominal growth is trending towards, that's a good buying opportunity.
So keep buying the dips is the trade ultimately. Yep. Okay, Tom, thoughtful stuff. Controversial at times as well. A lot to talk about. Tom, thank you. Tom Tsatsouras there of Strategas with some big calls, Lisa, in this Treasury market.
Basically talking about why this Federal Reserve wants to cut so badly and how much this has really raised questions about what could be behind that in terms of motivation. In terms of the conclusion for the investment thesis, I wonder how much Tom is on the same page with Bob Prince of Bridgewater, basically saying just kind of not cash, but short-term treasury is kind of what's the motivation to leave that if you're getting yield, unclear exactly when they're going to go lower, and, risk off.
The big hour is up next. Here's the lineup for you. Lisa Shannon of Morgan Stanley, James Steele of HSBC, Steve Risciuto of Mizuho, David Kelly of JP Morgan. Steve and David have very, very different views on what this Fed should be doing and how they view incoming inflation data. That's all coming up in the next hour.
I am so looking forward to another face-off. David, though, talking about this disinflation, how it's real, Goldilocks. Steve Rasciuto saying, kind of more on the same page as Tom.
CPI just around the corner, 34 minutes away. Equity futures positive by 0.1%. The scores in the bond market look a little something like this. Your 10-year yield lower by 2 basis points to 4.34. The 2-year down a single basis point to 4.73. The third hour of Bloomberg Surveillance up next. CPI just around the corner.
We're in an economy that still has a lot of inflationary pressure.
I would not assume that inflation numbers would be super sticky, but they would certainly be bumpy.
We are still looking for disinflation to continue.
We're talking about inflation behaving, okay? We're not talking about inflation accelerating.
Inflation will be sticky. Inflation will be absolutely sticky. And I do think that that actually warrants, over the long term, the Fed rethinking its inflation target.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Here we go. This is what it's all about. Finally, the boredom's over. The third hour of Bloomberg Surveillance begins right now. Inflation data 30 minutes away. Live from New York City. Good morning, good morning. The estimate in our survey, 0.3%. The previous number, 0.4. If it's 0.4, repeatedly, that's been called a bump in the road. Are we going to get another bump in this road? Chairman Powell with this to say recently. Too soon to say whether the recent readings are more than just a bump.
And maybe we get a sense of how the market is shifting, because it does seem like there is some sort of inflection point, as we were talking about before the data. I just want to make a little correction. It has been thrilling over the past 48 hours.
Sure.
We have gotten Treasury auctions. We've got Delta earnings. Market's done nothing. And that's basically where we're at. Because
you basically, want to get to the market board?
Because no one can really get any ahead of this based on the fact that we don't have an understanding of the Fed, their reaction function. We don't have an understanding of an economy that is utterly the most confusing thing I've ever heard.
Let me capture Lisa's excitement for you. Let's go straight to the market board and look at equity futures, which are positive 0.16% on the S&P. Yesterday, I believe, on the S&P 500, we were positive by 0.14%. I think on Monday, we were negative by what? Not even a tenth of 1%.
I mean, just shocking.
Huge moves, AMH. Massive moves to get your hands around.
At least Lisa had Delta this morning, which actually is moving in pre-market. When it comes to inflation, I'm actually looking forward to this hour. After the number, David Kelly versus Steve Rasciuto once again. I love David Kelly's note. It was a little bit of a humble brag. I'm still running marathons. And when he's talking about talks about it, what it means for monetary policy. In short, in long distance running, one key is to make decisions before it feels like you need to. Does that print today support that in terms of the Fed cutting before others say they need to?
Nothing humble about it. I just want to say that's not exactly a humble brag.
I've lost count of how many marathons that man has actually ran.
Good for him. I think that's wonderful.
I think depressing for the rest of us. 28 minutes away from that inflation number. The scores in a bond market, yields lower by 2 basis points on a 10-year, 4.34. Coming up this hour, Morgan Stanley's Lisa Shallett on her no-landing outlook. Mizuho's Steve Rasciuto on why rate cuts aren't guaranteed. And JP Morgan's David Kelly on why the timing of cuts is crucial. We begin with our top story. CPI data just around the corner. Morgan Stanley's Lisa Shallett saying this. Inflation has remained sticky. For the Fed, the hotter-than-hoped-for data is not simply a risk to its inflation and employment estimates. Rather, it shines a light on its long-held bias towards cutting rates. Lisa joins us now for more. Lisa, good morning.
Good morning.
Where does that long-held bias to cutting rates come from? What's it all about?
So, look, our perspective has been that for a long time, they've been really focused on managing liquidity. We know, as some of your prior guests this morning talked about, liquidity has begun to finally drain out of the system. You know, this has been a 2.5-year period where financial conditions have remained extraordinarily accommodative. And I think that they want to cut so that they can get to QT, the tapering of QT. They've tried to keep, quote unquote, an order to things. And that's what this is really all about, is them managing liquidity in the economy, this idea of ample versus abundant that they keep talking about. They don't want to have a Christmas 2018 correction in this market.
Are financial conditions tight or easy? I don't know. Deutsche Bank's Matthew Raskin put out this question. If financial conditions are this easy, is Fed policy that tight? Are we easy, tight? Where are we?
We are 100% easy. You don't see markets like this. You don't see credit spreads where they are. You don't see auctions going off without a hitch unless there are easy financial conditions.
That said, they are tight for some people, which is what we heard from smaller businesses and what we hear when we look at delinquencies on credit cards and things of that nature. Have you ever found the economy this confusing?
No, I mean, I think one of the things that has happened, and we can maybe trace it back as long as, the past 15 years of what zero interest rates have wrought, which is an extraordinary divergence between the haves and the have-nots, right? So when you think about it, for, the wealthier, 40% of the economy, high rates are actually income producing, and that's been stimulative. Right. For the folks who actually need credit, it has been a headwind. And I think that divergence is getting bigger and bigger and bigger, which is why, peeling apart and decoding the economy here is tough. Right? Because if you actually look at consumer confidence in the aggregate, it looks like it's drifting up. But when you look at consumer confidence by income cohort, right, the lower 2/3 are actually suffering and saying, hey, there's inflation, there are higher rates, my credit card payments are going up.
Which goes to sort of what do you do from an investment standpoint, given the fact that the Fed has to make a choice. Do they try to curtail some of the gains in markets, or do they try to sort of throw a bone to some of the lower income sectors who are really struggling? If they err on that side and they cut rates, are they just going to turbocharge what's been benefiting the upper class for the past, year, but also longer than that?
Yes, yes, and yes. And I think that that's why they've backed themselves into a corner. I think that this lack of stability is going to be with us for a while. And I don't think that they have a clear strategy for how to manage it.
Some words and phrases you've used: vigilance, maximum active management, reduced exposure to the US consumer, discretionary. Walk me through why. Why do you think margins are going to be challenged sometime soon? Yeah,
so if we peel things apart, the overall margin expansion of the Mag 7 last year was spectacular. It actually really drove the aggregate market cap weighted index, rebounded margins. Underneath that, margins are basically where they were pre-COVID, which suggests we're quote unquote normal, but we're not, expanding yet. And the question that we have, for that cohort, the non-Mag 7 cohort, is really is margin expansion going to come from? It looks, based on the inflation data, like costs are going up. Manufactured input costs from the ISM manufacturing are going up. We know the PPI has been going up. So that's a pressure. It's not at all clear to us that while, we may say that wage growth is decelerating, it's still over 4%. And so our basic contention is, without a lot of top line growth in this economy, which we may get for some cyclical sectors, it's going to be hard to get margins really going here.
You went there. Can it be made up with better top-line growth? And ultimately, is there a better way to play higher nominal GDP in America? Is there a better way to play it outside of the consumer?
So our contention has been that the best way to play what we're seeing right now, which is a rebound in global growth, a rebound in manufacturing-based growth, is with cyclicals, industrials, energy, materials, even financials, potentially away from some of the more general retail or consumer discretionary names.
You also point to the fact that there actually are more upside surprises coming from outside of the United States, and that kind of shift has kind of caught your attention. Are you liking emerging markets in areas that typically are more leveraged to a more positive cycle, even though we might not be heading toward one?
Absolutely. I mean, I think one of the things that we spend the most time educating clients on right now is the extent to which we're seeing all-time highs outside the U.S. You know, telling them the story about what's going on in Japan, telling them the story about the rebounds in industrial production data in Germany, right? After, you know, Germany's kind of languished for the last 18 months. It's an interesting story, and European markets have responded, and we think that there's more juice in that lemon, as they say, and emerging markets as well. Even China, as negative as people want to be on China, it does look like there's a little bit of, you know, improvement on the margin that's positive.
So just to sort of give this perspective, are you moving more heavily into Europe, into Japan, even into China, and out of the U.S.? Is that kind of the way you're playing this?
We are trying to rebalance, and we're trying to be diversified. That's part of the aggressive active management, is let's be maximally diversified, and let's take advantage of some of these emerging trends, which includes not just moving by sector, but moving by geographies.
You mentioned China. You touring, or is it a destination?
China cannot be a destination for our clients right here. I just think the volatility of policy, the volatility of geopolitics is too high. And so we've really been favoring a EM ex-China perspective, where, you know, we think that there are good opportunities in places like Mexico, Brazil, India, for example.
When you look at also, you're talking about, you know, infrastructure, industrials, energy. What exposure exactly? Is it the companies you like, or do you actually like some of these materials?
So we are owning both, right? So we believe that inflation is going to be stickier. We've owned the underlying commodities. That's been a decent trade, and we think will remain a decent trade so long as global growth is improving. But, you know, we also want to pick companies that are going to beat earnings estimates, right? Given where valuations are, it's our perspective that the only way this market keeps going is that if you have that earnings achievement and earnings surprise, where are the expectations most benign, right, or not stretched? It's actually in some of these more cyclical sectors where people weren't betting on acceleration in GDP, and that's been the surprise.
90 minutes until CPI. How are you going to play this?
We can't kind of play a print. Our best guess is that, you know, it's been telegraphed that we're going to see yet another acceleration in the 1 month, 3 month, and 6 month inflation prints. 3.4% headline looks about right to us. And our guess is that the market, again, you talked about how boring it's been, is positioned for that number. I don't think we're going to get a hotter number than that. But we'll have to see.
Lisa, love it. It's great to see you in person.
It's great to see you, Jonathan.
Fantastic.
Lisa,
I've missed
great
you.
to see you guys.
Thank you so much. Lisa Shallett of Morgan Stanley. Equity futures session highs up by 0.25% on the S&P 500, going into that CPI print in about 18 minutes' time. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Delta shares are up in the pre-market trade after a higher forecast and an earnings beat. The CEO, Ed Bastian, expects no let-up in demand in a busy summer travel season. It also helped to lift the shares of United and American Air. Delta is the first major U.S. carrier to give a preview of their current quarter. U.S. mortgage rates topped 7% for the first time in a month. That's according to Mortgage Bankers Association data. Home purchase applications fell by the most since mid-February. Now, despite that drop, the overall index did make a slight gain thanks to refinancing activity. The data cover more than 75% of all retail residential mortgage applications in the U.S. Godiva's parent company is raising prices for chocolate as the price of cocoa soars. Plattis Foods is still finalizing price plans, but it says that it expects global price increases in the high single digits. The company does expect some occasional customer pullback, and total units moved will be declining. Cocoa prices have more than doubled so far this year, surpassing $10,000 a ton. That's your Bloomberg Brief, John.
That's the important news. Danny, thank you. Up next on this program, gold trading near all-time highs.
The other impacts that we're seeing on things like gold, which are completely different. And I think the biggest force there is central banks trying to diversify their sources of reserves.
That conversation up next, live from New York City this morning. Good morning. Your inflation data, 16 minutes away. Inflation data, 8:30 Eastern Time. Going into it, the scores set up as follows. On the S&P 500, positive by 0.2%. Yields coming in just a touch. We're down 2 basis points on a 10-year, 4.3417. In the FX market, the euro unchanged, unmoved, 108.62 against the US dollar. And crude positive by 0.7%. WTI, 85.81. Under surveillance this morning, gold trading near all-time highs.
The other impacts that we're seeing on things like gold, which are completely different. And I think the biggest force there is central banks trying to diversify their sources of reserves. I think this diversification story will continue. I think we have gone through this. If we look over the last 50, 100 years in terms of the place of gold in central bank reserves, it has gone up and down through time. I don't think it will be a very long-term impact.
Here's the latest this morning. Gold flirting with record highs as investors await US CPI data in just a few minutes' time. HSBC's James Steele saying this: gold keeps rallying even though Fed officials have not made bullish comments and other factors in the financial market are not especially gold friendly. If the higher CPI number picks up yields, gold could hit some headwinds. Right now, however, momentum buying is overwhelming other facets of the market. James, I'm pleased to say, is with us for the first time in a long time around the table. James, good morning to you.
Good morning.
Good to catch up, buddy. It's great to see you again. Let's just talk about what's happening here and what used to happen. Typically, when you see yields moving this way, you don't see gold moving like this. What is happening? What is the relationship between the two?
No, that's right. We've seen a disconnect. First of all, yields have been positive for quite some time, many months now, a couple of years. And the gold market's been able to resist that. There was a disconnect that sort of started at late 2022 and has carried over to one degree or another. Now, we have had a lot of, recently this year, we have had a lot of buying that's come in as a safe haven and hedge against equities. You know, a lot of asset managers, portfolio managers, they have no choice but to be in equities, but they do have a choice about if they want to hedge and how they hedge. And gold's a standout in that regard. It's a very good diversifier and a very good hedge for paper assets. That started a lot of buying coming in, goosed by geopolitical risks. And that's taken us to levels where momentum trading, CTAs, hedge funds have come in more recently in the last couple of months and sent this market to all-time highs. This is despite the fact that the dollar's been pretty firm, and as you point out, yields have been firm.
Can we get to the geopolitics, the physical central bank buying, and what underpins that? What is that story really all about?
Well, there's a couple of things. First of all, you know, you need dollars, and we are running a substantial current account deficit and have done for some time. So many central banks have adequate dollar reserves that they can devote to some buying of gold if they wish to. And central banks are limited as to what they can buy. They only have a few fixed income instruments they can buy and a few other foreign currencies that they can buy. So if they don't particularly want to be, and I'm not saying that they do or they don't, it's up to each reserve manager. But if, say, they wanted to be out of the dollar modestly, reduce holdings slightly, say from 65% to 63%, not to get out of the dollar, but didn't want to go into the euro or the yen, gold is a marvelous sweet spot. You can be out of the dollar without actually being in another currency. The other thing, too, is that, again, like with financial risk, gold has proven to be a good asset to own during periods of elevated geopolitical risk. And gold has actually been going higher since the day after the Hamas attacks. If you look at the market, we declined from May, late May last year, right to October 6th, as the Fed, as it became clear we were not going into a recession, and the Fed was not going to cut rates, and we came out of the debt fiasco, and the bank stress situation eased. The gold market dropped right up until those attacks, and I'm not blaming it all on that, but if you look at that and geopolitical incidents around the world, it makes it likely that not only would a central bank buy, but others would buy as well.
You're making the sort of central bank buying a lot less dramatic than a lot of people who come on who say they are concerned about the sanctions that the U.S. put on certain places, including Russia and, you know, China. This is a concern for them, and that this is going to continue, and that there's a lot of legs here for central bank buying. Are you pushing back on that and saying this is on the margins? They filled their coffers with dollars, and they're just sort of rejiggering things, and it's pretty much done?
No, but I'm trying to find some moderate level in between. Central banks are major buyers, and they're buying at least double the rate of the average of the last 15 years. 2022, almost 1 out of every 3 or 2 out of every 5, 1 out of every 3 ounces of gold that was mined ended up in a central bank. So that's enormous. That's almost 1,100 tons. The year before that, it was more like 450 tons. Last year, I think it was 1,037 tons. We're looking for more like 800 tons this year, but that's still well above the levels. So we're just saying maybe not as high in the last couple of years, but higher than we've seen historically. But I think what many of your other commentators are pointing to, and I would agree, once central banks start on a policy course, it's usually multi-year. When they sold gold, by the way, and I remember when they did, my hair was gold at that time, by the way, back in the 90s, they sold for almost 20 years when they did sell, over 15 years. So once they start, and central banks also in the last couple of years published a lot of policy papers on why a central bank would want to own gold, and that was an alert that they were getting interested.
After the freeze on Russian assets, we saw central banks bring back within their control physical gold because they were worried about this. Does that set the direction that potentially we will see more of that in terms of the sanction policies coming out of the United States?
Well, Barry Eichengreen, I believe, and I'm almost sure it was him, that in a paper that he wrote, said that the threat of U.S. sanctions would be an inducement for some central banks to buy gold. And that would obviously...
Would you categorize as de-dollarization, though, or is that too harsh?
I think it's slightly too harsh. I mean, at HSBC, we're certainly in the camp that the dollar will remain the world's reserve currency for the foreseeable future, for a whole range of reasons. But the point I think to make is that's not to say that they need as many dollars as they have now. So the point being,
Interesting.
US dollars 59% of foreign exchange reserves. It's down from in the 60s a number of years ago. You don't have to go into another currency. You could go into gold, and that's what many of them are choosing.
James, this was great. I think you've reminded a lot of Brits at home of the brown bottom in the late 90s. And when he sold all the gold? Bad times. James Steele of HSBC. James, thank you, sir. It's good to see you.
Thank you.
Let's get you an update on inflation because we need to be talking about that in 6 minutes' time. CPI drops. Mike McKee is in Washington, D.C. to break down that number for you. Mike, what are you looking for?
Well, we're looking for continued disinflation on a short-term basis with both the monthly headline and core dropping a little bit. But because of energy prices and base effects, the year-over-year number for the CPI headline is expected to rise up to 3.4% from 3.2%. And that would be a disappointment to some. But the core are expected to go down on a year-over-year basis. That might make the Fed happy. See a lot of tweets this morning from people saying this is the most important CPI of our lifetime. Well, maybe not. Of the year, maybe, because it's going to tell us something about what the Fed is thinking as it goes into May and then into June. A rise probably means June may be off the table. A drop, maybe it comes on.
Mike, just real quick here, how high is the threshold to really shift the Fed, given the fact that we have gotten a number of hotter than expected inflation reads over the past few weeks?
Well, I think if the number goes up significantly, then it really does have an impact, and you'll see a big market trade on it. But CPI doesn't usually come in. It can surprise, but when it does, it's by a tenth. And a lot of that now is down to rounding. Everybody's looking at 3 decimal places on the CPI numbers. So it's going to take a lot for something like that to happen.
Mike, sit tight. Stay close. The inflation data, 4 minutes and about 25 seconds away. We'll catch up with Mizuho's Steve Risciuto, JP Morgan's David Kelly, those two reacting to the numbers as Mike McKee breaks it all down for you. The scores look like this on the S&P 500, positive by 0.1%. Yields come in a little bit lower, down a single basis point. The 10-year, 4.35. The 2-year, 4.73. Inflation data up next. Inflation data 20 seconds away. The scores going into it look like this on the S&P 500. Equity futures positive by 0.16%. On the Nasdaq 100 up by 0.13. Switch up the board and get to the bond market. We look a little something like this. Your 2-year down 2 basis points at 473.65. Your 10-year down almost a single basis point, not even, at 435.77. With the data, here's Mike McKee.
All right, we're looking for the CPI data to drop any second now. It seems to be a little bit slower than it has been. Here we go. We're starting to get some numbers in, and we are high, on the high side, 0.4% for both the headline and the core on a month-over-month basis. That pushes the year-over-year number from 3.2% to 3.5% for the headline, and for the core, we go to 3.7 from 3. We go to 3.8 from 3.8, so no change there. So a disappointing result in terms of the headline numbers. We'll take a quick look and see what we can find in terms of what pushed the numbers up. Food prices were not a problem, up just a tenth. Gasoline up 1.7%, so that's not a major issue. And then we always want to check the used cars and trucks. They fell by 1.1%, so there's something else in here that is pushing it up. It looks like shelter costs unchanged, basically up 0.4%. So I'll take a deeper dive into this and see if we can find out what the problem was.
I don't even need to go through the markets, Mike. You can guess. Another bump in the road, really. Equity futures on the S&P 500, negative 0.9%. We're down across the board. On the Nasdaq, we're down by more than 1 full percentage point. The Russ or the small caps negative by more than 2. Turn the page, get to the bond market. At the front end, yields up by 12 basis points. New highs for the year on a 2-year yield, 4.87. On a 10-year right now, up 10 or 11 basis points to 4.4684. With yields higher, you can imagine the dollar's stronger. It is against the euro. Switch up the board and look at the euro. Against the dollar at the moment, 108.06 with negative 0.5%. So equities down, yields up, dollar stronger. Mike McKee, are they going to call this another bump in the road? How long before we start calling it new terrain?
Well, you know, you're going to have the people like Raphael Bostic talking that way, maybe Chris Waller as well, because they were already concerned that inflation hadn't started to go down or hadn't continued to go down as they were expecting it to. And now this CPI seems a little bit worrisome because it continues a trend of the past 2 months. There was a thought that maybe January was an outlier, maybe February was an outlier, but now you've got 3 months, and I think people are going to start to say that is definitely a trend.
Which really raises the question, how much are we going to start to move toward the Raphael Bostic view of the world, as well as the Neil Kashkari view of the world of just cutting once this year, and that having sort of the message be, okay, we might go before the election season, but don't expect us to have to move again?
Well, that's going to be a tricky thing for them to pull off because it gives too much of a timing to it, and they don't want to bring the election into it. They will say, I don't think anybody's going to change their public view on how many cuts this year or to go to none between now and May 1st, because it's coming up fairly quickly, and we will get 2 more reports before the June meeting. But they might start dialing back this number, and markets are certainly going to start pricing in a 2-cut year rather than a 3-cut year. We get another month of this, they'll probably go down to 1 cut. But to say when would probably put them in dangerous territory. They don't want to, A, give the markets too much of a hint, and B, bring politics into it at all.
Mike McKee, stay close. Let's go through the numbers. 0.4% is the number. The estimate in our survey, the median estimate, 0.3. Strip out food and energy, we come in at 0.4. The median estimate, 0.3. Every time we've seen 0.4, this Federal Reserve has called it a bump in the road. Is it still a bump in the road? For the equity market, it might be more than that. Let's get to the equity board. On the S&P 500, futures backing down. We're negative by 0.9%. On the Nasdaq, down 1 full percentage point. The small caps, a struggle. We're down 2%. In the bond market, Treasuries down, yields up, now by 14 basis points at the 2-year, approaching 490. We're back to 488. And if you're on 450 watch, we're basically there, Bramo, on a 10-year.
And you can see this being bled out in the bond market in a significant way. You now see only 2 cuts priced into the market in terms of forward expectations. But when you take a look at the currency market, I know you're going to get there. I'm really interested in how much this puts pressure on other countries and other central banks. You see the euro breaking down. You also see the yen crossing that 152 mark, it really puts Japan in a difficult spot.
The dollar's stronger against everything in G10 right now. With us around the table to break this down, Mizuho's Steve Rasciuto, JP Morgan's David Kelly. Steve's been talking about the Fed wanting to cut, but the data's not cooperating. David Kelly, is this data cooperating?
No, the sound that you heard there was the door slamming on a June rate cut. That's gone. I think the problem is the Federal Reserve, and particularly Jay Powell, wants to achieve consensus. He's only had 8 meetings out of 51 meetings in which there's even been a dissent. And so he's going to try and convince the committee, but he can't convince the committee of something the committee doesn't, on average, want to believe. And so he's not going to be able to get consensus around a June rate cut. I don't know if he'd even want to push one at this stage. So unless there's something very weird in these data, I'd love to see what exactly is pushing this, because there's some, there may be things like tobacco prices or something pushing this. I don't know. It sounds pretty high, but it's definitely more inflation than the Fed wants. I still think that they ought to normalize rates over time. I'd be happy enough if they start to cut rates in June, but I think this means that they won't.
The words of Chairman Powell. It's too soon to say whether the recent readings represent more than just a bump. Chairman Powell in the last few weeks. Steve, do they need to change that assessment of this data?
I think they're creating a problem for themselves in terms of the promises of rate cuts, the inability to actually execute on them. Their forward guidance has locked them into something because they want to do something that the data is not allowing them to do. I think they ought to change it. Whether they will or not becomes an interesting question. I think there's enough doves on the committee that will be a difficult thing to sell. I think, as Mike mentioned, they're more likely to hold status quo and just, allow the markets to do the effective adjustment for them and wait till they get to the June meeting to make any changes.
I'm struck by the fact that core inflation came in hotter than expected, as well as everything else, at a time when we're seeing oil prices, when we're seeing more broad commodities increase, which creates this question of how much more could inflation rise. I'm wondering, from your perspective, Steve, do you think that this data raises the proposition of a hard landing because it forces the Fed to stay high, even if you see some weakening on the margins?
Well, I think the answer to your question is very simple. I define it as a hot landing, an environment in which the economy slows back towards, 2.3, 2.25 type environment, which is still above the revised CBO trend. I don't know if anybody noticed that, but CBO raised its underlying trend rate of growth in the economy from 1.75% to 2%. So my 2.25, 2.30 lumber is still above trend. That gives you a tight labor market environment, and it certainly suggests it's going to be very hard to get inflation to the 2% level. So could inflation wind up settling somewhere around 3 as opposed to 2? Yes. So that to me would be a hot landing, not a hard landing. But it still keeps the inflation percolating.
Check out this market move. Let's start with equities. Equity futures, the Russell getting absolutely slammed. We're down by more than 3%. On the S&P 500, down by more than 1%. David Kelly just moments ago, the sound of the door slamming shut on a June rate cut. If you're just joining us right now, 0.4% is the number. The estimate was 0.3. Mike McKee down in Washington, D.C. Mike, you've had a bit of time to chew over these numbers. What is underpinning this one this morning?
Well, the interesting thing is that there isn't any huge jump in any category except motor vehicle insurance, up 2.8%. It doesn't have a huge weight, but it does figure into core services, and that's pushed the numbers up. What you're seeing is a lot of slight increases in a lot of different areas. Rent up 0.5 after 0.4 last month. They were the owner's equivalent rent, the housing component, unchanged at 0.4. So that's still an upward weight on the overall numbers. And we're seeing the same sorts of things throughout this. 0.7 gain for apparel. Things that go over 1%, very little. But a lot of things moved up 0.1 or 2 during the month. And that seems to be what's pushing this higher. And that would make the Fed concerned because it suggests a broader base for inflation than just a few outliers like we've seen in the past.
Mike, thank you so much. And I'm looking right now at Supercore, someone noting that it's at 4.8%, not exactly what this Federal Reserve wants to see. David Kelly, I know that you've been really big on the disinflation, the immaculate disinflation, this idea that we were going to get a landing and that it was just sort of this natural base effects that would take hold. Do you question some of that now?
Well, actually, what Mike was just saying makes me feel a little bit better about the situation. That 2.8% in auto insurance, that's probably not a real number. I mean, last month they were saying that auto insurance rates were up 20.6% year over year. Now, I know they're up. I don't believe that negotiated auto insurance rates on a month-to-month basis are actually going up that much at this stage. I also don't believe that a year from now we'll be seeing also 20.6% on auto insurance. We must have gone up some more. And then also if rents are up, then the owner's equivalent rent is up also. So that it sounds like it's still the same problem of, about over 80% of the year-over-year inflation that we're seeing is coming from auto insurance and the government's measure of shelter costs. And both of those are very smooth, badly measured things which should come down over time. I will admit that inflation is coming. This is too much for the Fed, and they won't want to look into more details to find a reason to cut here. But it doesn't make me worry that inflation, in the long run, inflation is coming down.
Steve, your response?
It's an index. You take the index as what it is. A lot of these components aren't even seasonally adjusted at the micro level and the macro level. They're aggregated, so we can get proper seasonal adjustment behind it. There's lots of components in the CPI. The fact that some components go one way, some components go the other way. That's why we have an index. So I don't really look into the details. I look at the major aggregates and the components, and what they're telling me is inflation's not doing what they wanted on average, and this is a problem for them. They've laid out a scenario, and they actually lowered the bar at the March meeting to cutting rates. And the reality is the economy isn't even meeting that lower bar for them. So this becomes an ongoing quandary for them because they've created a financial market environment that's much too accommodative for what their macro scenario is and what their desire to cut rates are. And therefore, they've created a problem for themselves because their forward guidance is keeping the labor market tighter than it would normally have been if they didn't have this degree of forward guidance. The dots are a bad concept. They shouldn't be there. They lead the market in a direction that they should not go. This has been a mistake since it was created by Janet Yellen. Nobody at the Fed has backed away from it. The reality is I hope when they sit down and review it next year, they realize this is a dumb thing and they walk away from it.
David, do you agree? Do the dots just create this, problems within the financial markets?
No, I don't really have I don't have a problem with their transparency. I do have a problem with overly active monetary policy. I think that we assume, Steve, you were talking about how their monetary policy has kept the forward guidance has kept unemployment tight. I don't think that their forward guidance on rates is having that much of an impact on actual macroeconomic GDP growth. Because if that were the case, the fact that they've raised rates so much over the last 2 years ought to have slowed GDP growth down, and it didn't. So I think the Fed has a big effect on financial markets. You can see that today. I don't think they're having a huge effect on the economy. I do think that some of the ways that the Labour Department, despite the fact that it's an index, the way they measure inflation is adding some bumps to the bumpiness here. These are manufactured bumps. It's kind of like roadworks in New York City. It's not just potholes. It's actually roadworks that's creating these bumps. So I think the Bureau of Labour Statistics themselves are responsible for some of the bumps here. I do, though, think this is a fundamentally disinflationary economy. Inflation is coming down slowly, and I just worry about an overactive monetary policy, which we've had for many years, which basically distorts financial markets for no good economic purpose.
And you talk about running a marathon. You have to fuel yourself before you break down. So if June is slamming the door, you think you slam the door against June, when do you think the Fed should have to step in?
Well, I personally, I think I'd rather them get going slowly and sort of send the message, look, please pay no attention to this. We're not easing, we're just normalizing. I'd like them to sort of message that way. But yes, I do think that they ought to try to get to normal before they need to, because someday we're going to be sitting around this table and the Fed's going to be at a high level and suddenly the floor has fallen out for some shock or something, and so we're facing the possibility of recession. Then the Fed says, we've got lots of ammunition, we can cut rates fast. But I have never seen that one work out well. If the Fed has to cut rates a lot in an aggressive, responsive way, it always hurts the economy. So I'd rather they just gradually get back to a normal place. But obviously this morning's data doesn't help them do that.
I keep watching the markets right now, and after we got this hotter than expected print across the board, yields continuing to climb, almost really pushing up toward that 5% level, 4.93%, the highs of 2024. I'm also watching the Russell 2000. And Steve, I'd love your idea of this. You say a hot landing. And this raises a question of what this landing is going to look like if you do see some of the smaller companies continuing to be pressured, given the fact that the Fed really just lost their excuse to cut in June. As we heard from David, that was the sound of the door slamming shut on a June rate cut.
Yeah, again, this is the problem the Fed's created. So the reality is smaller companies get squeezed because they don't have the pricing power, but they're getting cost in the wage cost environment. And that's squeezing the profitability. And this is something I think the Fed really thinks they're attempting to do. They're attempting to create an environment where, David I'm in the camp that longer term there are global deflationary stories. The problem is there are a lot of domestic cyclical inflationary stories. And it's a battle between the global deflation versus the domestic cyclical. And this is a battle that's been going on, and the currency's been somewhat of the equilibrated between the two of them. But the reality of the situation is the domestic cyclical dominates more than the global deflationary over time. And the other thing is the Fed keeps on missing the importance of fiscal policy in this equation. It's not only monetary policy that continues to stimulate the economy, it's fiscal policy that continues to stimulate the economy. And therefore, the Federal Reserve's concept of what their neutral rate is, the natural rate that they're looking for, or R start, I think is incorrect. I think R start is substantially higher. I think the level of rates that needs to be in environment in order to bring inflation down is substantially higher than the Fed is assuming. And I do believe the market prices the dots. And that's a problem. The market takes a look at the dots and says the dots are this, and this is what we price in as soon as it happens. So the forward structure of rates anticipates the dots, and that's a problem, which is why they should be eliminated.
Let's talk about the price of fiscal policy right now. Can we bring up the bond board? This move at the front end of the yield curve. We're talking about a 20 basis point move on a 2-year yield. We took out 480, we took out 490, we're at 493.49. We're at 14 on a 10-year. There's your round number, 450 on a US 10-year this morning, 450.29. Pass that through to foreign exchange. The dollar's stronger against absolutely everything. Dollar yen took out 152. The euro broke lower to about 107.85. We're negative 0.7% there. And if you are just joining us, we said earlier this morning, it's quiet now, wait until 8:30. This one's loud. Big move. 0.4% is the number. The estimate was 0.3. Mike McKee, I want to come back to you. You've had much more time now. What's standing out to you? How difficult does this make life for Chairman Powell next time we hear from him?
It makes it a little bit of a public difference, but I don't think it's going to make as much of a difference inside the Fed, in part because of what both David and Steve are saying about the idea that this is not driven by a particular thing, but by several broader categories. When you look, and gets very nerdy, but this is where we are these days, a lot of people looking at the 3-digit numbers for the changes, and we actually see headline go down from 4.0 to 3.78, which rounds up to 4, and we see the slight rise in the core from 3.58 to 3.59. So it doesn't suggest inflation is reversing tremendously because of the rounding, but it does suggest that we have stalled out. And that's going to be the interesting thing for Fed officials to address. It probably means fewer rate cuts because they're not making progress, so it's going to be higher for longer.
Mike McKee, I want to talk about that decimal point. We'll do that with David Kelly. David, let's talk about it. This is an email I got just moments ago. Core CPI month over month was 0.359, which gets rounded up to 0.4.
Yeah.
You come in a little bit lower, you get rounded down to 0.3. Does that make a difference to you? Does that change the conversation in any way, shape or form?
No, but I think the other thing is, in any inflation rate between 2 and 3%, on the consumption factor, I regard as basically okay. I mean, I think the Fed is a little too focused on getting to precisely 2%, just as I think they were in the last decade, trying to raise rates up to 2%. I think trying to manipulate monetary policy, get rates inflation right down to 2%. I think they're a little too forceful in that. So no, I don't worry about it too much. What I look at are two things. One, yes, we've got a lot of demand, but we've got tremendous labour supply. I mean, we've seen increases we're at a 15-year high on the labour force participation rate for the working age population. We've got massive immigration, which is generating labour supply. Year-over-year wage growth at its lowest level since June 2021. So we don't really have a problem there. And then in the longer term, inequality, competition, and the lack of, we've had virtually no strikes so far this year, the lack of any union pressure to push up wages, all that suggests to me this is fundamentally disinflationary economy. I tend to agree with Steve that there are cyclical forces which are making it just a little slower coming down, but I'm fine with the idea that inflation is going to be drifting down and there's going to be a time when we're all sitting around this table wondering what the Fed's going to do to push it up.
You've said a few times that this disinflationary trend, which has hit some bumps in the road over the last few months, had nothing to do with the Federal Reserve. When you just talked about the labour market, you talked about forces that had nothing to do with the Federal Reserve. Why doesn't that play into what Governor Waller is saying, which is basically why do anything at all? What Kashkari is saying is why cut rates this year? Why doesn't that just play into that idea?
Because you're starting in the wrong place. If the Federal Reserve was at a neutral level, and I think the neutral level of the federal funds rate is a lot higher than 2.6%, but if they were at, say, 4%, then yeah, they should just focus on their golf game. They do not have as much impact on the economy day to day as they think. They spent a decade trying to speed the economy up, failed. Now they've been trying to slow the economy down, failed. It's clear that they are in a very rough stream with a very tiny paddle, and they are really not moving the boat at all. And so what they can do, though, with a lot of this active monetary policy is disrupt financial markets, misprice assets. Last decade, we mispriced housing terribly, and now a large chunk of younger Americans can never buy a house because home prices are just too high when you've got normal mortgage rates. We've mispriced a lot of speculative assets, meme stocks and mega cap stocks of some kinds, and cryptocurrencies. All were, these things were funded because the carrying cost of crazy was zero. So I wish the Federal Reserve would pay more attention to what they do to financial markets with their manipulation of interest rates and not worry too much about what they're doing to the economy because they're not that effective.
We played the should game. Can we play the will game? What do you think they will do?
I think they'll skip in June. I think they will set that up and then probably at the moment I think they'd probably set up for September and December. 2 rate cuts this year. Yeah,
can I just jump in there? Because I think I totally disagree with what David just said a minute ago in terms of what's driving this thing and about monetary policy returning to some natural rate or neutral rate and what that neutral rate should be. The reality is the Federal Reserve was trying to stimulate the economy when there was a debt overhang. The debt overhang was weighing heavily on the economy, and the Federal Reserve was doing what it was supposed to do, offsetting that debt overhang with very, very low subsidy levels of interest rates. COVID cleaned out that debt overhang. Now there is no debt overhang. Balance sheets are exceptionally healthy. The economy has back its animal spirits. And therefore, the Federal Reserve needs to be taming back on those animal spirits by keeping the level of short-term interest rates high enough not to allow the economy to get too excessive in its growth rate, to create a substantially higher rate of inflation that then gets embedded in the system. This is the mistake the Federal Reserve made in the 60s that created the 70s. And I think they've learned from that, and hopefully they've learned from that and realized not to succumb to the idea that there is some natural rate or some neutral rate that we have to get back to, or if monetary policy just gets back to some lower level where we're all fine. The reality is they have to fight against the animal spirits that are created from an economy that has very healthy balance sheets, low corporate debt servicing burdens, low household debt servicing burdens, and a tight labor market that's feeding the engine of the consumer economy.
David?
I think you're talking about Wall Street animals and not Main Street animals. I think
Wall Street is Main Street. I hate to tell you, a lot of it has the same effect. The companies drive their share prices. They keep their employees. All those things matter. What happens in terms of the stock price matters what happens in terms of Main Street.
All right, we just disagree. I don't think that monetary policy is as effective on the economy as you think.
But let's talk about where Wall Street meets Main Street, right? We're going to have a real Wall Street response to this. We already are seeing it right now. And there's going to be a 1-2 punch because we see the price action right now. And then at 1 p.m., we're going to get an auction of 10-year notes that's really going to test the appetite of a market that's looking very skittish. Steve, how vulnerable is this market to a real upset that will actually disrupt some of this easy money conditions and this sort of happy talk that we've been hearing all year?
Well, the reality is these moves tend to be somewhat partially reversed out by the end of the day. I understand the 10-year auction is coming, and it will probably be a sloppy auction as a result of it. But I think the more important point to understand is what this says to the average CEO in this country is inflation is hot. Why am I not raising my prices? Okay, I may be getting squeezed on my margins. I've got to get double-digit earnings. I've got a tight labor market. Inflation is up. Other people are raising their prices. Why don't I just raise my prices? And that becomes the self-fulfilling prophecy of creating the inflation environment. And this is where the rubber actually meets the road, because if I'm sitting there in that executive office and I'm looking at my stock getting hit, I want to drive up my stock price. How do I drive up my stock price? Do I go out and suddenly start firing workers? Or do I say everybody else is raising prices? Why don't I?
And this really feeds to this question, David, that a lot of people are expecting margin expansion this year. And where is it going to come from? It's going to come from some of these price increases. So is that one of the theses kind of underpinning some of the rally that we've seen in equities?
Well, I hope not, because it would lead to higher inflation if CEOs do that and they say, OK, now's the time to raise prices. Or if workers say, now's the time to demand a wage increase. The thing is, we wouldn't have come down from 9% to 3% or 3.4%, 3.5% of CPI. That wouldn't have occurred if businesses were actually able to do this and workers were actually able to do that. What we're seeing, if you look at the inflation, when we get the data, and we look at it carefully here, we're still going to be in a situation where 80% of that inflation that we're looking at right now is simply the government's measure of shelter costs and auto insurance. You look at energy, food, goods, everything else, it's not particularly inflationary. And that has to say that we've got a competitive economy in which, yes, everybody wants to raise the prices, they're just scared to.
It's a fantastic conversation, Steve. I'm afraid I've got to wrap it up. Forgive me. Steve Rasciuto of Mizuho, alongside